You're adding value as a man.
Live.
Smaller.
All right, let's get started.
Interesting.
Billings.
But yeah, this, for whatever reason, this one I was just like, what is-
On to tab 6, non-core fixed income asset class review.
Mr. Chairman, Mr. Lord, welcome back. I'm Jason Brett. I'm the Director of Public Markets, and I'll be reviewing non-core fixed income asset class. If you thought trust fund and core fixed income was cool, well. You ain't seen nothing yet. But I'll start looking on page 2. So this shows some of the topics I'll cover. But really the main goal was to give you a better understanding of the asset class, what we're trying to achieve. And a better understanding of the strategies that make up the non-core asset class. I'll cover our history in the asset class, and some of the policies that govern non-core fixed income, as well as some of the characteristics of the strategies in the asset class. Turning to page 3, I thought it would be helpful to start by providing some history of the high yield market, given that high yield is the largest allocation in the asset class. Originally, the only bonds that were high yield were what they call fallen angels. That's bonds that were originally issued as investment grade that were later downgraded. Historically, companies that couldn't earn an investment grade rating had to borrow from banks, short-term loans, high interest rates. So there was an opportunity for investment banks to disintermediate the market. And as a result, a market for new issue high yield started growing in the 1980s. Another driver of growth was the leveraged buyout boom. It was largely financed by high yield bonds. Those were very highly levered buyouts, typically, which didn't always end well. Also, there were some unsavory characters at the time that left a bit of a stain on the high yield market. And the term junk bonds was very popular at the time. But nevertheless, the markets continued to grow. It's now a legitimate asset class, valued at around 1.4 trillion. If you look at the bottom table, that shows the composition of the high yield market and how it's changed over time, going back to 2009. And what you see is a dramatic decline in the rate of triple Cs, which are the lowest rated bonds, offset by a corresponding increase in higher quality double B rated bonds. Now, 2009 was just after the GFC, so there were a lot of in the wake of the downgrades from that. But there has been a gradual decline in triple C issuance in the high yield market. One reason for that, at least we've seen more recently, is that private equity, which had historically been financing through the high yield bond market, it's largely moved into the leveraged loan market. It's a quicker, more flexible financing, more confidentiality than in high yield. But the bottom line really is that the market has changed dramatically since the 1980s and even since around 2009. On to page 4. So what are we trying to accomplish in non-core fixed income? Well, the primary goal is to achieve higher yields and higher income in core fixed income. And how do we do that? Through higher coupon interest, higher income, which are really the main drivers of returns in non-core fixed income. That being said, there can be times in the market, typically during times of stress, when prices fall. In those cases, there can be opportunities to get additional return from some level of capital appreciation. But primarily think of this asset class as being income oriented. Another important aspect is that companies are contractually obligated to pay the coupon interest, which has considerable value. There is one exception in the asset class that I'll discuss later, but companies have to pay the coupon interest or they'll be in default. In constructing the asset class, we've emphasized diversification. So we've constructed a portfolio of different strategies that gives us diversification by issuers, by sectors, and by geographies. And to the last point regarding our goals and objectives in non-core fixed income is that performance versus the asset class benchmark is not the ultimate measure of success. We've chosen the strategies in asset class because we think they can give us greater returns than those in core fixed income, and 2, that they can provide us some level of diversification. So the non-high yield strategies were not selected necessarily because we expect them to outperform high yield. I'd also add that in non-core fixed income, contrast to what you see in public equities, passive investment is not really a viable alternative. There are some ETFs, and specifically to the high yield ETFs, they consistently underperform the index and they aren't cheap. Any questions so far? Move to page 5. So our history in the asset class goes back to 2009, when we hired our first high yield managers for pensions and trust fund. There was a period after 2015 where high yield was a standalone asset class. But in 2019, the non-core fixed income asset class was created using our existing high yield managers and also by expanding the policy statement to allow for investments in preferred securities, emerging markets debt, and convertible bonds. We added preferreds and EMD in 2020, and then convertibles in 2023. Specific to state fund, high yield was added back in 2020. Page 6. The slide shows some of the policies that govern non-core fixed income high yield among the different asset owners. For CAP, the approved range is between 5% and 9%. We've discussed the permitted investments. There is a floor and a cap for the weight of high yield in pensions with a minimum of 25% and a max of 75%. And there's also a limit on how much any single non-high yield strategy can be in the asset class, and that's 50%. The benchmark for non-core fixed income and pensions, the asset class benchmark, is the Bloomberg Barclays US Corporate High Yield 2% issuer cap. The 2% issuer cap is there mainly in cases where large investment grade issuers have been downgraded. And we first saw this back in 2005 when GM and Ford were downgraded, and being such large issuers, large companies, they would account for an outsized weight in the index. And that's why there's a 2% cap there. Currently, I think there are only a couple issuers that are larger than 1% in the benchmark right now. Trust fund, state fund policy, each has a range of 0 to 6%. Page 7 shows a few key terms. Now, there are a lot more that we may use when we're discussing the asset class, but I think these are a few of the more important ones. First will be spreads. You hear me talk about spreads during the investment updates every quarter, but spreads are simply the additional yield you get from a high yield bond over a comparable maturity U.S. Treasury. So if treasuries are 4.3%, which is close to where the 10-year is now, spreads are 180 basis points. Yield on high yield will be around 7%, which is where we currently are. Next one, duration. Simply put, it's a measure of interest rate sensitivity. And what's important as it relates to high yield is high yield has a much lower duration than does core fixed income. And we saw this in 2022 when the Fed was raising interest rates and markets were selling off. One might think that in a sell-off that the riskier high yield would do worse than core fixed income, but that did not happen. High yield actually outperformed core during that year, and that was largely due to having less interest rate risk. The next term, subordination. This describes the security's position in a company's capital structure with, you think of senior debt at the top and common equity at the bottom. This is especially important when we look at preferreds. They sit lower in the capital structure than senior debt, and there are some high yield bonds that are issuers that have senior debt too, but really specific to preferreds that this subordination means that you're behind the senior debt in terms of claims on the company's assets in case of liquidation. But with preferreds, the issuers, which are a lot of large banks, the difference is that many of these issuers have investment grade senior debt. So the lower rating that can come from the security comes from the subordination risk, that risk of being further back in line on the claims of the assets of the company. Although preferreds do have significant exposure to investment grade. Liquidity is straightforward. When you sell an asset quickly without overly affecting its price. What's important here is that non-core fixed income securities mostly trade over the counter. They're less liquid than core bonds, and in times of stress, you might not be able to buy or sell easily. Any question about? On page 8, we're discussing some of the main risks. Biggest risk in high yield compared to core fixed income really is credit risk. The risk for not getting all your money back. We talked about interest rate risk, which, although it's lower than core fixed income, is still a risk. Call risk. So with high yield bonds and preferred convertibles, they're generally callable, which means the company can redeem the bonds before maturity. That usually means you lose out on future interest payments and have to reinvest the proceeds at lower interest rates. Now, in high yield and preferreds and converts, typically there's a period of call protection, say between 5 and 7 years. And if the issuer calls the bonds after that point in time, that typically you'll have to do it at a premium to par. Liquidity risk we discussed. The next ones really apply to emerging market debt, political risk. Some of these governments are less stable. In addition, some countries lack credibility of their central bank to effectively execute monetary policy. Say the president hires a relative to run the central bank, that's typically not a great arrangement. But I'd add, though, in recent years, many EM countries have seen increasing credibility of their central banks, particularly as it pertains to addressing inflation. So there has been some improvement there. Currency risk and emerging market debt, that can add to volatility. In the case of bonds issued in a country's local currency can affect returns measured in US dollars. The currency effect, although this year has been mostly a tailwind. And finally, it's just part of life in fixed income, but it's critically important that your upside's limited. You hope to get your interest and your principal back. It's a little bit different issue. We'll discuss that later on the other side. But what it means is that your losers can hurt the portfolio more so than you see in stocks, as you don't have the opportunity for a big winner to help offset your losers. And that's a key reason that we've historically chosen high yield managers that tend to be more conservative in their approach, that are highly diversified, with the goal being really to limit the number and the magnitude of potential losses to the portfolio. Page 9. See here the total in non-core fixed income assets, about 1.4 billion among the different asset owners. And you can see in the breakdown in the top right, which shows the absolute dollars as well as the current exposure versus the approved ranges. With the performance section, performance in cap recently has been helped by non-high yield issuer strategies, namely emerging market debt and convertibles, which really has been a shift, as over the last 3 years, those strategies have tended to underperform high yield. And when you look at the performance section, you see this every quarter. To understand performance of portfolios versus their benchmarks, a few things to remember. So for trust fund and state fund, which only have high yield, the relative performance is determined by the performance of the high yield manager or managers versus the index. For cap, there is that same effect, but also to the driver of relative returns is affected by how the non-high yield strategies do versus the asset class benchmark, which again is the high yield benchmark. As mentioned recently, emerging market debt convertibles have outperformed high yield, which is health performance versus benchmark over the last year. Page 10. So to discuss the individual strategies within the asset class, starting with high yield bonds. So these are corporate bonds. These are companies issuing debt. And what makes them high yield really is higher credit risk. And that can come from a few different ways. It can be from simply carrying higher debt levels. It can come from smaller companies with less diverse revenue streams, or it can be companies that are stressed or distressed. This company's having difficulties. The table below shows the different categories of investment grade and high yield bonds. You see anything rated BB and lower is considered high yield. And another difference from core fixed income, shorter maturities and lower duration, which I mentioned before. And I mentioned our approach for our preference for more conservative, excuse me, more conservative managers in high yield. It's tend to be a headwind for a long period of time. It's been a long time since we had a real full credit cycle. If you look over the last 6.5 years, high yield market in those 30 quarters, high yield market has been up 24 of those, 80% of the time. And if you look at the annual returns, the last 15 years, high yield's been up 12, so 80%. Any questions about high yield bonds? Next, moving to page 11. So preferred securities, this one gets a little more complicated, but here are a few key things to remember. And we spoke about subordination and how subordination increases the investor's risk, that if things go bad, you're not at the front of the line for claims on the company's assets. But that for most banks and preferred issuers, the issuers themselves have investment grade rated senior debt. So the lower rating for the preferreds comes from the subordination, not necessarily the credit risk of the issuer.
Could you repeat that?
Say that again, Jason.
So compared to a high yield bond issuer, they issue their debt, it's rated high yield. The credit risk of that security really is tied to the credit risk of the issuer. In preferreds, which is heavily dominated by financials, a lot of banks, the banks will issue a preferred which might be rated lower than their senior debt.
Mhm.
And the reason for that is just the position in the capital structure, lower position in the capital structure, not necessarily that the issuer itself has a higher credit risk. It's just that subordination effect comes with some risk. And so typically between three and 5 notches lower than the senior debt is.
Thank you. I didn't hear you. So that was good. Appreciate it.
The additional information is good. For those of us that are like.
Banks and insurance companies are the largest issuers of preferreds. They comprise about 75% of our preferred benchmark. Banks issue preferreds to help them meet their required capital ratios. For treatment for that, it does help them keep their debt to equity ratio lower than if they issued straight debt. And there are no voting rights typically for preferreds, so they're not ceding more control of the company by issuing common stock. The biggest difference between other strategies in the asset class and preferreds is that preferreds pay a dividend, not a coupon interest. So dividends are discretionary, they're not contractual, so the company isn't obligated to pay them. Companies are required to pay the preferred dividend before they can pay common stock dividends. But related to that, if you remember anything about preferreds, issuers don't just decide to turn it off. They don't just decide to stop paying the preferred dividends. That would be a huge negative signal to the market. Basically saying, hey, we're out of money. That's not something we typically do.
Jason,
Uh,
Jason, is there still a distinction between cumulative and non-cumulative preferred dividend?
Yeah, that was a discussion with our, actually our preferred manager that's in the quarterly review a few weeks ago, talking about the different types. Typically, the preferreds we're in are non-cumulative.
Okay.
So cumulative preferred would mean if you stop paying it with, say, the bank's in distress, that before you pay the common dividend, you have to make up for all the dividend payments that you missed. That's not typically the
Not
case
typical anymore.
in the securities we own now.
Is all of non-core fixed income managed via asset managers? We don't do any direct.
All external.
Okay.
So the different types of preferreds, really, there are 3 different types that we have exposure to. And this is where it gets increasingly complicated, so stop me if you need some explanation. The first type is what would be the traditional type, the $25 par preferreds, also known as retail preferreds. These are perpetual. They don't have a maturity. They are callable, but not having a maturity means that they have very long duration, so they're very sensitive to changes in interest rates. The next type is the over-the-counter or institutional preferreds. These typically have an initial period of, say, 5 years where the dividend rate's fixed and the security is not callable. But after that period of call protection, the dividend rate then resets, typically to a new floating rate. And last type would be contingent convertibles, also known as COCOs. This is really a European bank structure that was created in the aftermath of the GFC. So the issuer has to meet certain capital ratios. If they don't, there's a trigger that typically the value of the security can be written down or converted to equity. But so the exposures really, we have our blended benchmark is 60% over the counter and 20% each to the $25 par preferreds and 20% to COCOs. The manager has some flexibility around that. Typically, they've been overweight COCOs more recently, which have outperformed the other structures in preferreds. Any more questions about preferreds before we move on to page 12, emerging market debt or EMD. The first thing is that there is no standard definition of emerging markets in the investment world. So the list of EM countries for EMD is not the same as it is for EM equities. Now, there is some overlap, but really the criteria is set by the index providers. So MSCI sets the criteria for international equities, and our benchmarks are JP Morgan indices. So they set the criteria for what classifies as an emerging market country. And in contrast to the other types of strategies, emerging market debt is government bonds. These aren't corporate bonds. So these are issued by a government, although we do have a small allocation to EM corporate bonds. And this also includes what are called quasi-sovereign bonds, which are entities that are wholly or partly owned by the government. Those bonds can be either explicitly or implicitly guaranteed by that government. If you think about state-owned oil companies like Pemex in Mexico, Petrobras in Brazil, those are two of the biggest quasi-sovereign entities in EMD. Two main categories in EMD are hard currency and local currency bonds. Hard currency bonds are typically issued in dollars, occasionally in euros, and local currency bonds are simply issued in the country's local currency. Local currency bonds tend to be more volatile, but there can be times when they outperform. That was one of those times. So when we hired an EMD manager, we chose to have a split of hard and local currency, and we picked a 70-30 split of hard and local. But the manager does have some flexibility around that ratio. With a weaker US dollar year to date, local currency bonds have done especially well. So it's good to have had exposure to that area of the market. Credit ratings at EMD tend to be lower than governments in developed markets, greater economic risks, political risks, also less diverse economies. You see a lot of commodity producing countries in EMD. But that being said, there are investment grade emerging market debt issuers, and investment grade makes up about 60% of our blended benchmark. Any questions about emerging market debt?
I think you probably have by country farther, but I mean, like, what would the top 3 countries be?
So the top would be Mexico. This is portfolio exposure. Mexico, Brazil, South Africa, and I think Peru and
China's no longer considered EM, right?
What's that?
China is no longer considered emerging.
China is in the EM. And
Oh, is it? Okay, awesome.
we, as it pertains to China, since you brought it up, we have not granted our manager the ability to trade and invest directly into Chinese sovereign bonds.
Makes sense.
We do not have any exposure there. Moving to page 13, the last strategy in asset class, convertible bonds. These are hybrid security with some bond characteristics and some equity-like characteristics. So if you break it down into 2 pieces, really, so there's a bond element that comes from the payment of coupon interest, which is contractual. And the equity element comes from the conversion feature. So that allows the holder of the convertible to convert the securities into equity at a specified ratio of common shares to the number of bonds owned. And by providing that conversion feature to investor, which presumably could have greater upside, that allows the issuer to pay a lower coupon interest rate. So there is more upside in convertibles than in other strategies in non-core fixed income. But to the bond aspect, payment of coupon interest provides some element of downside protection. And if you look at the market, really, there's a kind of a sweet spot with, depending on the price of a convertible bond, there's an attractive asymmetry of returns. That there's more upside than downside. But when you move to the extremes, you lose that asymmetry. So a high price convertible, its price changes largely correlate to the change in the stock price. So you're losing the downside aspect. On the opposite side, a low price convertible trades more like a bond. Say the stock is sold off and really the conversion feature holds little to no value. Those are known as busted convertibles. But to keep in mind that, you know, a distressed company may end up in trouble and defaulting, in which is the bond value is gone. And so deep credit analysis is key to determining what they call the bond floor, the value of that bond element of a convertible. And there are different styles of managers in converts. Some have more exposure to the equity sensitive convertibles. Others have more exposure to the busted convertibles. And in the middle, what would be what you call balanced managers. And we chose a balanced manager that is a little more conservative, that has a strong credit focus. Given that the strategy is in non-core fixed income, we were in something that looked a little more fixed income like. So we may be giving up some upside, but we think we'll get much better downside protection and be able to exploit that asymmetry of turns, which is what makes convertible bonds attractive to begin with. Issuers of convertible bonds do sort of lower the interest burden relative to what they would pay for straight debt. And two, they can put off or delay any potential dilution from issuing equity. They can do that, delay it to a time, presumably sometime in the future when the stock price is higher, where there's less dilution is less of an issue to existing shareholders. In terms of sectors for convertibles, technology, healthcare, biotech, they're big issuers of convertibles. And two, I know many convert issuers have no other debt on their balance sheet. So given that, most of the convertible bond market is not rated by ratings agencies.
I'm sorry, do you get a lot of direct deals when you work with a manager with this? I mean, I see a lot of companies are coming to institutional to say, hey, listen, can we do it? I mean, are you doing direct deals typically at all, or is it just through manager?
Everything is being managed by the external manager. Yeah.
Thank you.
I don't think I've ever been pitched a convert deal, but if I did, I'd probably delete it pretty quickly. So young, high growth companies tend to dominate in converts. But there has been a recent increase in issue from other sectors like utilities that increased their issuance of convertible bonds. Like, why would a utility issue converts? Well, one thing they can do is by issuing the convertible, they can use that capital to keep their interest costs down because they pay a lower coupon interest with convert, and they can use that capital to pay down more expensive debt.
Do you guys use these as individual companies, or do you use them as some kind of a hybrid stock? Again, I don't know what I'm trying to say. Investment vehicle that covers lots of companies for one company.
So this is a number of different issuers. So much, I think there are between 60 and 70 issuers in the portfolio. Going to page 14, I thought it would be helpful to compare high yield to stocks and bonds in terms of their historical returns and historical volatility. And here I'm using the high yield index and the Bloomberg US Ag Index, which is core investment grade fixed income, and the S&P 500 for stocks. And at the top, you see the 20-year returns and volatility. And what you see is kind of what you'd expect, higher returns than core fixed income, but lower than stocks. And to higher volatility than core fixed income, but also lower volatility than equities. If you look at the bottom chart, shows the upside and downside captures for core fixed income and high yield relative to the S&P 500. So what we're measuring, the up capture is how much do core and high yield increase when stocks are up. In this case, high yield goes up a little less than 50% of what stocks do when stocks are on the rise. And the opposite too is the same. The downside capture, how much do core bonds and high yield decline when stocks are down, and it's about the same. So the down capture is a little less than half for high yield of stocks, which I think is also what you might expect. More upside and downside in high yield than core fixed income, but also less upside and less downside than the stocks. Page 15. So starting at the top, this shows the 5-year returns and volatility of the different strategies in non-core fixed income, as well as their up capture and down capture of each versus the high yield index. I think what you would notice here, as I previously mentioned, to emerging market debt converts typically more volatile than high yield. If you look at the bottom table, it compares the non-core fixed income asset class versus core fixed income asset class. So high yield or non-core has had a good run in outperforming core for the last 5 years. And the table in the middle is a comparison of characteristics of the strategies in the asset class versus core fixed income. And I just point to a few things here. You look at the yield and duration relative to core fixed income, higher yields, lower duration, except for emerging market debt, which has comparable duration to core fixed income. 2, I would point to the exposure by credit rating. And you can see here that preferreds and emerging market debt have significant investment grade exposure. And 2, you see that convertibles are mostly unrated.
So the light is the US high yield bond index. The dark is the actual fund manager. Right?
Right.
Yeah. And so the emerging market is lagged, yeah?
So sorry to repeat that for the first part. So the top.
So if I'm looking at the graph, I see.
The dark is the returns. The light blue is the volatility. Of
Oh,
that
it's
strategy.
volatility, okay. And so the index, so sorry, I wasn't seeing where the index is in comparison.
I'm sorry, I can't hear you.
Yeah, it's kind of hard to hear both ways this way.
I can hear very well.
Where the index is illustrated is not on these pages, is it?
No,
Great, thank you.
not in the returns and volatility. The up and down capture is relative to the high yield index. So you can look and see for each of the different managers, the different strategies, how much they increase when high yield is up, how much they decrease when high yield is down. I think I cut off or did not include the legend on there. That is important. It's the index is not included in the returns and volatility. But on the previous page, you see the 20-year returns and volatility included back there. So
It'd be great to get the index there.
page 16. So this is the page you see every quarter in the investment update. In the top right, we see the aggregate exposure by credit rating category. We talked about some of those differences by strategy. Put them all together, and that's the aggregate exposure. We discussed the exposures by individual strategy. We also discussed some of the differences by sector in the strategies. So high yield tends to be high in communications and consumer related sectors. Energy is just behind that, but very low in financials and technology. Preferred is very heavy in financials with no tech exposure. Emerging market debt, just government bonds. So that shows up on the sector breakdown as hard currency and local currency sovereign bonds. Convertibles are heavy in technology and healthcare and consumer related, but low in communications and almost no financials. So when you see this chart every quarter, the sector breakdown, you can refer back to the different strategies in their sectors and exposures. You can see some of the differences. It's one of the reasons why having preferreds, which are heavy in financials, give us a much higher banking exposure than high yield. And some of the other differences too. Obviously, there's no exposure to foreign government bonds in the high yield index, which we get through our emerging market debt.
So is this high yield preferreds or EMD and convertibles, are they all, do they carry their own benchmarks or are we just referencing to?
Each have their own. So the high yield managers use the high yield benchmark that we use for the asset class. For preferreds, we have a blended benchmark for 3 different security types. EMD is a blended benchmark, again, 70-30 of our currency and local currency. And convertibles has its own Bloomberg balanced convertible index. So we do measure that. But at the asset class level, it's being compared to the next yield benchmark.
And that info's in the RBK deck, page 44 and 45, if you want to see the versus the individual indices for each manager.
And page 17, discussing the due diligence and manager research process. I'm not going to spend a lot of time here, but really the main points are that the process is the same that we use for other public markets asset classes like domestic and international equities. In equities, we lean heavily on FactSet as our analysis tool, but for non-core fixed income, the primary analysis tool is Bloomberg. We can look at holdings analysis by credit rating or sector and other different ways. And 2, we can look and do performance attribution to determine the drivers, what's helping, what's hurting in a certain period, drivers of performance by either sector, credit rating. And 2, we're always trying to keep our finger on the pulse of the market. So we do have ongoing discussions with other managers. Some of these managers I've had discussions with going back 5, 6, 7 years. And 2, periodic discussions with RBK. Page 18, just a few comments on the current market conditions. Annual spreads have seen some volatility earlier this year, mainly in April. We're back to relatively tight levels. But quality of the market's very high. And we discussed the high weight of double Bs in the market. The absolute yields are close to 7%, which is a reasonably attractive level relative to history. And it's about much more attractive than the yields in 2021, which were in the 3.5% area. More recently, we've seen some non-high yield strategies lead the way. I mentioned convertibles and emerging market debt having outperformed high yield this year and over the last 12 months. We haven't made any large changes to the asset class, but we have made some smaller redemptions out of high yield over the last year and contributions to convertibles and emerging market debt for the last 12 months.
So if we, I guess you can go into page 45, you can see that from a gross perspective, the funds have done pretty well compared to the index, yeah?
For the asset class?
Yeah, for like, if we look at Shankman high yield, fixed income, gross, it's done very well against the, or I guess not, now that I'm looking at, there's some that it's not, but.
And if you look at the since inception numbers for high yield managers, it kind of, the gross returns kind of track the index. And so that gap kind of matches the management fees roughly. And it varies a little bit by manager, but it's pretty close.
And who do you think is the best manager? I mean, that's a hard one to say, and one that you might not want to say publicly, but it looks like Payton's done pretty well, yeah.
So a lot of confidence in the manager in terms of the performance of
Gross versus net.
starting out when we funded them in 2020. It was a rough time for emerging market debt. And that's one of the things with having some diversification by a strategy that recently that's been a tailwind, right? Where other strategies, high yield has still had relatively strong returns, but I think over the last year, converts and EMD have done better than 12%, which is really good returns for that type of strategy. Page 19, I don't think I need to summarize anything, but again, any questions you might have, I would point you to the page 21 in the appendix. This is a chart from one of our managers. It has a lot of information on the chart, and I love this chart because it has all the information in terms of returns and default rates, and it's a lot of information right there. It's pretty helpful to refer to. I've included this in back years in asset class reviews. So if you have any questions on that page, I'll try to answer them.
So,
And then,
so what is that saying? That's saying that right now spreads are pretty low.
Yeah.
Default rates are pretty low.
Yeah.
So that would indicate a good economy.
be consistent. The high yield doesn't need a huge growing economy, but pretty steady is pretty good.
Yeah.
I would say I didn't mention it in the market commentary, but one thing I'd like to ask our managers from time to time, and this would be whatever the asset class is, like, where's the excess? Where are things kind of out of whack? And the excess in high yield went over to the leveraged loan market, basically. And there's not a lot of excess in the high yield market. There are certain areas that may be weaker on a secular decline in certain business strategies, but generally speaking, leverage levels are very reasonable. Interest coverage levels are very reasonable, and there's a cushion. So if things do get worse, we're still in a pretty good position to get our money back. So now on the other side, spreads are relatively tight, but 7% is not a bad yield. High yield. Return. And then on the last page, it shows the breakdown. This page 22, the breakdown by strategy, and this is in millions. Shows you the breakdown of different exposures by manager and cap and trust fund state. Any questions? I'd be glad to attempt to answer any of the questions you might have.
Thanks, Jason.
Thank you.
Right, moving on to tab 7, RBK. Thanks for joining us, Becky.
Absolutely. Great to be here in person, and our colleagues, Jim and Paige may be online. If you hear a voice from the screen coming, I'll be sure and try to listen for that. But if you'd like to turn in that section to page 2 of that first executive summary report, and then we'll go through a few pages here and then go into the main performance report. There's just been so much news about what has happened in the markets in April with the tariff reactions and then retrenchments on tariff policy or uncertain tariff policy. One of the pages I'll show you in just a moment is how much we are surprised that the market has kind of dismissed all of that concern, or a lot of that concern, since that time and continued to forge ahead. So we have gotten a very nice finish to the end of our fiscal year, and I'll show you in a couple pages. You beat your assumed rate of return in the pension plans by 2% this year, net of fees. So that's been a tremendous result. As we look at some of the market backdrop, obviously there's been a lot of equity market volatility that was tied to the tariff announcements in early April, but we've made a lot of progress since that point. If we look at what's been happening across a number of asset classes, it was a positive fiscal year and a positive quarter for many of them. If you look at some economic indicators in the upper right-hand section of this page, you can see the unemployment, which is now actually 4.2. As of the end of June, this assessment shows 4.1. That is starting to show some signs of weakness, and that's one of the things that or weakening. That's one of the things that the Fed is concerned about while they're trying to fight inflation at the same time. If you look at inflation, which is the second bar from the left in the upper right-hand panel, you can see that the CPI is basically right at median where it has been since 1914. But we certainly saw a couple of years ago where that CPI number went up to 9.1% as of the middle of that year. So we're sure thankful to have that CPI number back in the 2% range the Fed is looking for, although we're not at 2%, as you know. Government debt, a lot of conversations about what the big beautiful bill will do for that going forward, as well as existing levels of government debt, but it is high relative to history going back since 1966. The VIX, which is a measurement of volatility, I have another chart on this in just a moment, does show notable spikes as we pass through April, but if we look at relative to history, we're kind of at median in terms of where equity volatility is, and then consumer confidence a little bit below median. And that's not surprising given all of the changes we've seen in our market, change in our administration, change in tariff policy, and the global kind of supply chain and trade balances. Not surprising, that's just a little bit below median. If you look at the bottom section of this page, the middle column is 1 year that matches up with our fiscal year ending in June. When you just look down through that list, there isn't an asset class with red type for June, which is terrific. And you had some terrific asset class tools that you've used in your portfolios, which have really helped the fiscal year to date results. As we look down the list, the big surprise this year is that international equity outperformed US equity, and that was helped by a weakening US dollar. The US dollar has come back just a little bit since this particular assessment as of June, improved by about 1% relative to a basket of other currencies. But that was a tailwind to fairly good stock market results in non-US countries. From emerging to developed, we saw this result. So that's a very interesting result that we've seen this year, and a change in the picture in terms of non-US economies beefing up their industrial complex, as well as their defense spending with these wars that are right at their borders or close to it. Much more sensitivity to being prepared for defense and investing in those industries. So bottom line, when you look at the 1 year return of these asset class that we list here, the best performing liquid asset class mentioned is international small cap. And we have some of that in your portfolio. The developed world had the return of almost 18% as defined by EFA. Emerging markets were up 15 and the S&P 500 was up 15. And really, when you look at this list, the small cap market here in the US trailed, and that is still being impacted by the higher interest rate environment we've been in. As you look down that list, the bond market for the last year gave us a return of 6%, which is a very nice return. It's been nice to have higher yields there than we've had for the last several years, but that certainly is a good result. And when you look at real estate, a positive return, which has been a change in a trend that we've seen for the last couple of years. It's been good to see those property values become a bit more stable to benefit from the income that those properties are paying. And then you can see a couple of other measures. HFRI fund of funds is a hedge fund measure. A broad universe of hedge funds had a return of just around 7, and then the commodities market had a return around 6. So very good returns here. Since this snapshot, we've actually seen the equity markets improve relative to the numbers shown here, which has been nice and refreshing thing to see on a calendar year-to-date basis. So on the right-hand side, the yield curve is something that has gotten a lot of attention, especially when everyone's waiting for the Fed to take action, wishing the Fed would take action, demanding that the Fed would take action. And of course, they haven't yet, but the big, as you know, the big meeting taking place in Jackson Hole on Friday is going to be, the world's going to be dialing in to hear what the unspoken messages are and what the spoken messages are But for our own Fed, as you know, there were 2 dissenters to leaving rates unchanged at this last meeting. That has not happened for a very long period of time. So I think we're seeing some cracks in the conviction of the Fed to hold steady. But at this point, they've continued to. And when you look at where the yield curve is as of June, it's that light green bar that's towards the middle of that chart on the right-hand side. In blue is where we were in March, so not a lot of change, but a little bit of lower interest rates, kind of as we call them in the belly of the curve. But the point is, if the Fed were to begin their interest rate declining or reduction program, it would move that shorter duration security yield curve down, and we would have a little bit more of an upward sloping yield curve. Right now, it's pretty flat with a slight incline between the shortest and the longest term securities, but still pretty flat at the end of the day. The next page is a little bit of what I hinted at, which is the market reaction in terms of volatility. So in the middle of this page is what happened in April. If you look at the heavy black line, that was the VIX measurement that I told you about. See the big spike up that we saw, a lot of volatility increase there. But look what happened to that since then. It's just kind of petered out to the same pattern that it had earlier in the year before the trade announcements were made. If you look at other indications, such as what's happening with shorter term securities, the SOFR rate, as well as what's been happening with corporate spreads blew out for a little while, quote unquote, became wider than they were and then have come back to kind of the trends that they have had. That's the top dashed line as you see in this chart. And the price of oil, certainly was higher at the beginning of the year, but didn't really spike around this time of market volatility. It's more a function of supply, demand, and what's happening in the Middle East, all combined relative to looking at other supply sources. So with all the volatility we saw in April, we're just kind of back to the trends that we've been seeing in some of these other indications. The next chart I think is fascinating, the quilt chart.
I still don't understand this.
Well, what it's doing is if you start on the left-hand side and flow to the right, it's taking the top performing asset class, and the asset classes have the same color as you go from left to right. So if you just look at the green, the darker green, that's the S&P 500. And you can see since 2011, how many times the S&P 500 was towards the top of the chart versus the bottom of the chart. In many cases, it's been, middle of the chart and above. And 2023 and 2024, it was the best performing asset class, as you can see here, with returns of 26 and 25% respectively. Again, that's that magnificent 7 domination of technology-oriented stocks. And by the way, those are the same names that have been driving the rebound since April here in our market. And it's actually the same stocks that are weighing on the market today, as investors become concerned off and on about the ability of the prices of these tech stocks to stay very high relative to their long-term earnings. But the thing that's so interesting, I think, about the year-to-date, which is the June period, the first half of this calendar year on the right-hand side, is you can't really find another period of time where international equity in all these 3 definitions, large cap, small cap, and emerging, are the best performing. So that has definitely been the theme that drove especially the first calendar quarter of this year. But if you look at last year, for example, 2024, 2023, and just look at the EFA, which is the dark blue, you can see it was middling in 2024 and second best performing in 2023. So we're glad we have a healthy allocation to international stocks along with our US stock market investments. And the worst performing asset class for this 6 months was small cap US equities. Again, a higher interest rate environment makes it very difficult for small companies. And in the long term, the philosophy is that there is a premium there for investing in smaller companies. They're not as highly researched. There's a lot more fundamental research that can be done on these companies over the long term, but you do get periods like this when the cost of their capital is higher, that they have had much more difficulties relative to other asset classes.
So, Becky, the year to date on this chart is only for 1 quarter?
It's 6 months. It's through
It
June.
is 6
Yeah.
months, okay.
Yeah. So the next page, 5, actually summarizes the returns that we saw out of the pension funds at the top of the page. So as I mentioned, your fiscal year-to-date return was about 2% above the assumed rate of return at 9.5%, 9.46% net of fees. That is terrific. I think if we were all sitting after the first quarter of this calendar year and looking at where the world may be going, I don't think it was as apparent that we'd end up in such a great place by the end of June, but knock on wood, we did it, and now we're off in a new fiscal year. So we have the longer time periods, of course, you can see for the quarter to date and calendar year to date. So this is looking at the June quarter on the left-hand side, a very healthy return of 5.4%, 5.35. That was a big equity rally that we experienced. And you can see by the calendar year to date, you can recognize that most of the return we got for 6 months was because of the second quarter. And then for 3, 5, 7, and 10 years, our returns were 9%, 9.6, 8%, and almost 8% for 10 years. So very good history. We have our benchmark that you can see here in the next line, and then the difference row shows you that for the 3-year and shorter periods that we've underperformed our benchmark, and for 5, 7, and 10 years are outperforming it. Again, as we've talked about for so many meetings, that's just really led to benchmarking our private assets. And the only way to do that through finding an investable asset that looks like those private assets is public market indexes, which we're off to the races in the case of equity, for example. So that's what leads to that shorter term noise. And as you've probably all read, the private equity markets have been a little quiet in terms of distributions. Their valuations have been lagged. Venture capital is still been struggling a bit. The private credit markets, which is another important piece of your private market portfolio, have continued to do well, really driven by yield. But when you compare your private investments to the public market benchmarks, you will get these mismatches in terms of performance trends. But over the longer term, which is how we should look at our private investments specifically, and really the whole portfolio, doing very well. The ranking compared to other peers, actually for this fiscal year, we ranked a little bit below median in the 60th percentile. A lot of that was really driven by, we have a higher real estate allocation than a lot of peers, which really provided a positive return for this fiscal year, but a much softer return than the equity markets. Yet we need it for diversification. We need it for not being like the return patterns of the equity markets. We really rely on our equity related strategies for growth in our portfolio. We rely on fixed income and strategies that aren't highly correlated with equity to help us with our return patterns over time, to not be so affected by what's going on with the equity market. So in this particular fiscal year, we did rank below median, but for longer periods, very strong rankings, as you can see. And over the last 10 years, you're in the 14th percentile. So you're in the top quartile, just missed it for 5 years, but in it solidly for 7 and 10 years. Any questions on this before we go into some of the more details that follow?
So you're saying that the drag has been real estate the past 3 years?
That's in terms of our ranking relative to peers, and in a very strong equity market, yes.
You guys usually do like a complete attribution analysis. That's down the road here.
Yeah. We'll get into that in a little bit more detail, and a look at risk as well.
So the numbers up above are net of fees other than
Yes.
the rank, which is gross.
Yes, the rank is gross, but it's all apples to apples, so that
In that
we're,
sense,
yeah. So, And the rank is just telling you what's happened with other pension plans. It doesn't give you the answer for what is appropriate for Montana. But it's just another measurement to say, what are they doing? And I'm going to show that page to you shortly and with a picture of how different you are in some of these categories. If we look at the next page, you can see the pie chart. This is the consolidated asset pension pool, and it's on page 6. You can see the visual showing you of the 15.7 billion, what categories those assets are in. And just roughly, if you add up our public equity investments, it's about 42% of our portfolio, and fixed income about 21% of the cap portfolio. And I just say that for convenience because we do divide those into 2 different categories each. To that, you can add the private investments at 17%, real estate at 12%, real assets at 6%, and then finally cash. The schedule on the bottom of this page and the next page shows you the asset class performance, net of fees again, and the relative rank. So if you look at domestic equity, we are indexed here in Montana for domestic equity. There are some different products in that portfolio, which I'll show you a little later, that invest in the whole stock market, some that invest in small cap, for example. But overall, you are just indexed relative to the domestic equity markets, and yet a 14.5% rate of return for the fiscal year in domestic equity. International actually beat it with a 19% rate of return, 18.7. And you can see compared to the ranks here, compared to other peers, that index strategy in US equities gave you a better than median performance in the 40th percentile, and international equity in the 36th percentile. So it's just interesting to note too, when you look at the domestic equity rankings over 3, 5, 7, and 10 years, your index program, I've lost count of how many years we're in the index strategy, is close to 10, isn't it? We're getting close to 10.
No, we've only been indexed for about
Haven't it?
4 years.
4 years, completely. Fully indexed.
We haven't commercial before.
Well, you can see how the rankings have looked good. It's been very hard for domestic equity managers to add value when you add up a whole diversified portfolio of them. International equity, if you'd had less in emerging markets in some periods and more in small cap, or depending on your value versus growth allocation, you can see here that we've been a little bit below median compared to our peers. But actually, when you look at the longer term comparisons, we're beating our benchmark by 9 and 18 basis points over the last 10 years. So again, the impact on the fiscal year was very strong returns for equities. The next page, I apologize, the top bar that shows you the time periods got cut off as we went to page 7, but the fiscal year to date is in the middle, and then 3, 5, 7, and 10 to the right. You can see here that core fixed income gave us a return of 5.5%. And this was behind our custom index. Longer term, you beat it in core fixed income over 5, 7, and 10 years, basically flat for 3 years. A lot of portfolios in their core fixed income do mix in non-core sectors as well. So I would not put a lot of weight at all into the relative rank. A lot of portfolios have just one fixed income portfolio, and it combines high yield, emerging market debt, and the other sectors that we just went through. So kind of have to combine them a bit when you're thinking about what your total liquid fixed income performance has been. Now, when you look at fiscal year to date for the non-core, as we just went through with Jason, a 10.25% rate of return for your fiscal year, terrific added value by being in these other non-core fixed income sectors. And that performance has been true for 3 years in terms of beating it. And actually for 5, 7, and 10 years, that non-core fixed income has beat your core fixed income portfolio. So it's been worthwhile to take that additional risk and be more diversified overall. Your real asset portfolio, and this is a combination of strategies, as you may know. So inflation-linked securities, infrastructure, commodities. We can see here the fiscal year-to-date return was good at almost 8%. Longer term, track record strongest at the 5-year mark. And we compare that to a custom index. So in the longer term, doing quite well there as well. Real estate, I mentioned the fiscal year was positive, 1.5% rate of return. The 3 years really kind of capturing this dip in the real estate markets that we saw starting in 2023. You may recall that in 2022, real estate was one of the best performing asset classes when the equity and the fixed income markets corrected simultaneously in the worst fixed income market we have seen in the history of the ag. So we're thankful we have it. It just so happens in this particular environment, it's had a softer return than some of our other asset classes. Over 10 years, though, has given a return of about 6%. And you can see relative to our index has been adding value. The private investments, private credit and private equity combined together, a 4% rate of return. This is compared to small cap equities and leveraged loans, which are the liquid forms of investable assets that are as close as we can get thematically to the private equity and the private credit world. We're beating that benchmark over the long term, but while especially public equities have been doing better, and some of these sectors you can see that we have lagged it recently. But for 5 years, that 14% rate of return, 11.7 for 7 years, and 11.6 for 10 years, very strong returns. And in fact, our private asset portfolio, or private investments portfolio for the 10 years is only matched by the domestic equity portfolio in terms of absolute returns. And that has been because we have been in a very unusual environment with domestic equities having this magnificent 7 stocks that have dominated the return of the stock market. Finally, we have cash, which is, for a fiscal year, for 1 year, earning almost 6% in cash is a terrific thing. We can all remember periods when that was almost zero. But you can see its result. Already looked at the trust fund pool performance in our earlier presentation, and then finally STIP, our short-term investment pool, a return of almost 5%. So these are the building blocks of the portfolios as we'll review them that I just wanted to go over at summary level, and then we'll dig down into a few more details after this and touch on your risk report. Any questions before we move forward? All right, just a real quick note on page 8 of the same section. We keep talking about how highly valued US equities are. This is shown on the left-hand side at the bottom of this page. If you look at the US large cap equity market since 1995, the PEs are in the top quartile. In other words, the price for the earnings of those US equities in large cap are very expensive. When you look at growth equities specifically, also expensive relative to their history, also going back to 95. Large cap value, even though value has underperformed as a theme for the last few years with a few quarterly exceptions, they are also fairly expensive. Small cap is also expensive, but not as much as large cap. So this is something, again, that we need to keep in mind. The value of an asset does matter over time, even though investors can continue to prop them up with a lot of optimism about AI and technology in general, for example. If you look at the next page, which is in contrast for international equity, especially if you look at the developed international equity, the second column from the left, and then the leftmost, which is looking at the developed and developing worlds together. They're not in that lower quadrant, but they're also not at the top either. So this is showing you that on average, the international equity markets are valued much more like they have been over time and not in that highest quadrant like US equities are. When we move ahead, I'll have you move to the second section in this tab, tab 7, and move to page 4 of that section. It's a pie chart for the retirement plans that shows you the total assets as of June. So I'll wait till we're all there.
So where are you directing? us to?
We're in the next section, and this is still in tab 7, but page 4.
Thank you.
So retirement plans, a total assets of $15.9 billion, as you see in the left-hand side of that. The public employees and teachers' retirement systems, as you know, the larger systems, the asset values are on the right-hand side, 7.6 billion and 5.4 billion respectively. If you move to page 9, here is the promise chart about your structure versus other public plans. In this case, plans that are larger than 5 billion. Again, this is not a recipe for how to allocate assets. It's just a comparison since we do give you a rank compared to other systems. If you look on the left-hand side at where that green diamond is in the breadth of US equity allocations, you're basically in the middle compared to other plans in the 49th percentile, just showing you have very similar allocations at 28.2 versus 27.6 for the median. Your non-US equity allocations just slightly higher than median. This helped our performance relative to other systems in this regard. Fixed income, US fixed income, and then non-US fixed income, if you put those together, that is about 16% in US equity strategies overall versus other plans at about 21. So we have a little bit less in the fixed income markets. Alternatives, this is 22% is the median, and you're about 24.8. Now, if you think about what's in there for other plans, this is a combination of possibly private credit, but certainly private equity. And if they have hedge funds, that's where it would be. And as I mentioned, the hedge fund result for the fiscal year to date is about a 7% rate of return. So in this particular environment, if your mix had an allocation that's spread across those types of vehicles, rather than having more private equity, it would have looked better than the result that we had from a performance perspective in the alternative portfolio. But we're investing for the long term, and actually that private investment portfolio has done incredibly well for you over the long term. So you have a little bit more than the median plan at about 25% versus 22, but it's a combination of strategies. The one that I mentioned, which is quite different relative to other plans in this snapshot, is having more real estate than other plans. And you can see here the green diamond towards the top of that chart, and having about a 12.7% allocation versus about 6.5% for median. Again, this is not a formula for how to invest, just a comparison of what other plans have done. So let's skip ahead to the risk report on page 22 of this same section. I'm thinking again, continuing to think about the total portfolio. We've looked at the total fund results. We've looked at how the individual asset classes have performed. So thinking about a few risk-related measures as we go through this report. The first is we show you 5-year rolling Sharpe ratios. This is the risk-adjusted excess return versus a risk-free rate. And where the public employee system is that light green result, kind of in the middle of where all your other asset classes are. And the observation is here when you look on the right-hand side, the second bolded number that shows the net of fees result for the public employee system shows that you have a positive Sharpe ratio over 3, 5, and 10 years net of fees. Again, risk-adjusted excess return compared to a risk-free rate. And then it shows you the schedule of what various asset classes have done in their own Sharpe ratio analysis. And some of them show up in red because they've had, again, when you take their return and then compare that to the risk-free rate, the risk-free rate is a much higher return than it used to be. It's not 0 anymore. It's about 4.5%. So we do see some negative Sharpe ratios for core fixed income, for example, recently in real estate and then private investments. But again, a lot of caution looking at volatility related measures in some of those illiquid investments. The next page 23 just is another, just check in these risk reports on, has anything been happening in our asset allocation by theme? Really, you've had a very consistent structure over the last few years, looking at how much you have in capital appreciation assets versus inflation related and capital preservation. These are the big, if you were to take all your asset classes, you could put them in these three buckets, and the allocation to those buckets has been fairly consistent over time. And liquidity, if you look at what's been happening with liquidity, we're a mature plan, which means that we need to support those benefit payments through thinking about this in our structure. You have about 62% of your assets that are really available for sale every day, 62%, and then about 35% that are illiquid or take longer to present for sale. And that would included in that is real estate and private equity, for example. So not a lot of huge changes, but your not liquid category has grown if you look at relative to 2020. Moving ahead to page 24, risk and return. I promised we would look at that. This is looking at the last 5 years, and it shows all your asset classes individually. And then it shows you the universe, the all public plans greater than 5 billion, right in the middle of the chart. You can find it by having about what a 9.5% rate of return and about a 7.5% standard deviation. That's in blue. Just to the right of it is our public employee retirement result. And you can see a little bit more volatility for that 5-year period, but a little bit more return as well. And that's on a net of fees basis. On a gross of fees basis, which is really what you should compare to the public plan median, we've actually beat it from a return perspective, at just a little bit more risk. But over a long period of time, I'll show you some charts that show it's a very good trade-off. The other asset classes you can take with a bit of a grain of salt in the case of the private investments, in that they aren't marked to market every day like stocks and bonds, but this is just the observed volatility of those investments, not the inherent volatility. So if you look at your private investments, they've had a return over 5 years of about 14% with about 6% risk or standard deviation. Again, that's not because they're less risky than equities. That means they're just marked to market less frequently. If you look at the most volatile assets in our portfolio from a volatility of price, it's our international and domestic equities. They're on the right-hand side. On page 25, we look at risk and return over a 5-year period compared to other plans. And this, again, is just another comparison. We have another comparison earlier in the report for 10 years that shows you a very consistent message. But one of the things we don't necessarily cover every meeting is that we show you 5 years, you look like you have good performance relative to the index and from a volatility adjusted perspective. But if you look at how the plan behaves in up and down markets, this is something that's important to see. We're a mature pension plan. We need to pay out those pension benefits. And again, this is the analysis of the pension plans that we've got here. If you look at the last 5 years, and if we take our benchmark, when the benchmark is down, that's a definition of a down quarter. When the benchmark is up, that's a definition of an up quarter. When we look at how our performance has played out over time, you can see that we have beat that benchmark by doing so with less down market participation. When the market is down, we're down less. When the market is up, we participate, but we're not getting every last dollar there because of the diversification. So this is a good result as we look over time. Now, keep in mind, there's been 7 down quarters and 13 up quarters. We have no way of knowing how many of those experiences will go going forward. But when we do asset allocation and talk about that later in the year, balancing risk is a very important part of that conversation.
Yeah, I think we talked about this last time. The benchmark is classifying private as small cap.
Yes, private
So
equity.
that's it's very hard to actually do a real comparison.
And this is exactly what other plans do as well. They'll either classify it as small cap or they'll classify it as something they can't invest in, which is the whole stock market plus a premium, an illiquidity premium. So the S&P plus 2 or 3%, or the Russell 3000 plus 3% are very common measures, or the all global equity index plus 2%. You can't invest in
Well,
that.
how would you make this chart better? I guess, I mean, like, I look at it and I'm like, if you didn't know, you'd go, holy cow, look at the Montana fund has got such low standard deviation and better return than the benchmark. But if the benchmark has such volatility with 20% of it being tied to a small cap index,
Mhm.
it's gonna show that. So, we've talked about this. I think we have a discussion at the next meeting. I thought it was supposed to be this meeting, then we had new benchmarks discussed. But like, what is a better, like, how could we, I mean, I imagine that this is tight and I imagine that we do great, right? But what would be a better, how do we show this more effective? I guess, to me, it's kind of a misleading graph. Like, what would be a better, in your opinion? There is something to be said, well, what is investable that you're giving up, right? You have an opportunity cost to invest in small cap, you have an opportunity cost to invest in large cap.
Yes.
But the group as a whole has decided we are investing X% into private equity or into something that, so to use that, well, that's the opportunity cost. It's kind of already that the horse is out of the barn, so to speak. Like, reality, we should be tracking what our allocation is to something that is an accurate benchmark for it.
First of all, we'd love to do an education session to show you what other public plans are doing. They're doing either exactly what you're doing to benchmark private equity and use the small cap market, or they're using the large cap market and adding a premium to it. So they're taking away the advantage of saying, what is something that I can invest in as an alternative? And saying, we just want to track, are we doing better than the large cap market? Are we doing better than global equity markets? So their volatility comparisons would be very similar in that they've got something more volatile in their benchmark than their actual private investments.
Why is that decision to do it that way versus use publicly available information on, here's what the universe, I mean, we talked about this already, and I guess I don't understand what the decision is. Why not use the current existing commercially available analysis of, hey, private equity, venture, et cetera, from vintage year X? That's what the average return, average standard deviation is. Why wouldn't you do that? I'm just curious.
Number one, you can't invest in it. Number two, we do look at those measures over time and looking at the returns of the Preqin database or the other databases that are out there to see how they perform during the same time periods. But they have the same relative volatility issue. They have
You can't invest in it is interesting.
You can't.
Because I guess the question is, and this would be the question for the board to think about, like, does that matter? Like, is it comparable to look at, hey, here's all the returns of private equity during this time. Even if you couldn't invest in it, even if there wasn't an index that you could actually invest in each single one, but it gives you a numerical answer versus finding something that you could actually invest in, but doesn't replicate as well. Does that make sense?
Yeah, actually, you'll find that a lot of systems have made the same exact, and that's what we'd love to bring you as an education to show you what others are doing. They're doing either this exact same thing and recognizing that if you choose an asset class that's most comparable, that is liquid and has a benchmark to it, recognizing that the benchmark is going to have more volatility than those private investments. That's one trade-off. Another trade-off is to compare your private equity investments to something you can't invest in, like the S&P plus 2 or ACWI plus 2 or Russell 3000 plus 3. You have the same volatility mismatch between that and the private markets. But the private markets do have comparisons that are grouping all private equity together that you can compare most effectively in an internal rate of return analysis that puts public equity and private equity on the same playing field. Those don't flow into these reports because they're time-weighted returns, not dollar-weighted returns.
Oh, okay.
So there is a difference, but they are used. Both theories are used in looking at how are our private investments doing.
I think as a board member, we have to say, okay, John does an amazing job, right?
Mhm.
But I wanna, it would be nice to see that John's or the board, the executive, the board itself has done a really good job about finding private equity managers. And we can use that because we can see that because we can compare that, oh, by the way, the US highly lever, I mean, there's hundreds of indices that, or tracking methods from like, PitchBook or Preqin, whatever, and Wilshire. I mean, it doesn't even get, I mean, there's a lot of different trackings of private equity.
Yes. And
Performance.
Mhm.
And so I understand it's a very good, I guess I'm still fuzzy on the decision.
I think it'd be great to have an education session to talk about those comparisons you just talked about are terrific with internal rates of return, because that's the return that's available from those various benchmarks. They're available on a lagged basis,
Correct.
and
yeah.
they're used as comparisons for how your internal rates of return are done. But that is a different calculation methodology than how we get to our time-weighted returns here in this report. But
Got it.
again, this
That's-
education
yeah, got
session
it.
can cover
Thank you.
both those worlds to show you exactly what other people are doing. And it's a very similar discussion they're having when they're looking at charts like this, but they're recognizing that they're going to use something like the method you use here in their performance reports where you're bringing all assets together. But when you're looking at how your private investments have done, it's actually the most accurate way to look at how they've done relative to other private equity investing opportunities is in an internal rate of return analysis, which is exactly where all those sources you just mentioned are perfect, because they're all calculated in the same methodology. But again, we'd love to bring an education
So
session.
why don't we add that? Oh, go ahead, John.
Sorry, I keep cutting you off.
So, we are gonna bring that in October. We do look at all those types of things that you're discussing.
Mhm.
We look at them internally when we're evaluating those managers. We will bring you in October with the deep dive. More of a, hey, here's what our portfolio looks like against the State Street indices, which we can see internally.
Mhm.
One of the reasons why we don't do that here or in other places, because it's costly. So we have to go out and buy all of those things from third-party providers. There are a lot of biases baked into those indices, I guess I'll say, where you have survivorship bias and other things. Won't go through all of that. So that kind of high level, we've just made the decision to go with that top level benchmark that way. I guess I would argue in some ways, I don't think it really changes what we would do one way or the other. But like I said, we do look at it on an individual basis when we're evaluating managers, and then
Well, from a board perspective, we have to have something that guides us to what has been good and what has not been good.
well, I guess I would
Yeah.
say even on Becky's chart here, if you look at this chart, okay, I completely agree with you. The volatility is, way to the right for the benchmark that we currently have. But if we're looking at it versus all of the peers, I would say that's
That's a
a
good point. Sure.
relatively
Yeah.
apples to apples
Yeah.
discussion, because all of our peers are doing similar things. They all have private equity. and
They're
venture capital.
the ghost.
And so
they're-
we
they're the
look-
Ghost tabs.
Right,
Yes,
so we
yeah.
still look, in the upper right hand.
Yeah, that's
or upper
awesome.
left-hand quadrant there. So I think, yes, I'd kind of set that benchmark aside because of the volatility there. But, other than that, I still think there's some value in,
Mhm.
where we stand versus peers, because that is more comparable.
And maybe exactly on that theme, and these are great questions and points. Again, on the theme of risk, when we look at how we're doing relative to peers on standard deviation, in the bottom section of the same page on the left-hand side, over 5 years, our plan standard deviation is low compared to peers. You can see in the 55th percentile, so we're below. Our Sharpe ratio, we've already looked at, just relative to, absolute returns that we've generated. Our risk adjusted excess return compared to peers ranks just underneath the top third of other plans. We're in the 34th percentile. Our downside risk, when the markets are going down, we tend to do better. In fact, we don't lose as much. Our upmarket capture is the second column from the right. When the markets go up, we do very well compared to other plans. We're in the 37th percentile. And when markets go down relative to other plans, we go down less. So these are just proof statements that the overall structure is working. Other things that are interesting is on page 26.
Becky, just a quick
Sure.
comment. I remember having this discussion several years ago.
Mhm.
And I think there were two other things that I remember, and John, you can correct me if I'm wrong, but in addition to being costly, a lot of those indices are proprietary and that they wouldn't like to see them in public facing documents like these. Is that fair on some of them
Maybe on some of them, there are ones that you could buy that they would.
that you'd be allowed to
At
report?
least at the top level.
Okay. And then the second question is the universe of public equity is very large. So
Mhm.
to find one that it mimics exactly what we're doing would be impossible. So then you're always going to be
Yeah.
trying to explain why you're different from that
There's
index.
always a
too.
mismatch with the benchmark.
Yeah.
Yeah. Agreed.
So quickly, Becky,
Sure.
as we look at performance
Mhm.
reporting in October,
Mhm.
perhaps the education component you're talking about,
Absolutely.
a majority, if not the biggest chunk of that, so that we can just
Yeah.
hopefully get an understanding and,
Do a deep dive.
yeah,
Absolutely.
Okay.
Absolutely. Happy to.
I'm sorry, so I mean, like, yeah, I hear this, and what I don't see is that. I know, because I see it all the time, that here you can compare a manager to, at this year, there's the venture. Benchmark, and if I'm a financial advisor, or Dan, you're talking to someone who's got a ton of money. As an advisor to them, you'd say, hey, Tom or Julie, you invested in ABC venture fund. They only produced 6%, whereas the average venture fund during that vintage year produced 10%.
Mhm.
That's actually good information to make decisions on, that maybe
Mhm.
that manager is not the right manager for us. That's why I think it's critical to have the real twist here is on the IRR versus
Yes.
and I understand that now, so thank you.
Yeah.
But I think it's important for us. This is kind of is John getting in the weeds? Is this really are we wasting our time on this? I actually think this is super important, that if you want to know, is the manager selection doing well?
Mhm.
You have to be able to compare that to vintage years or similar private equity strategies, and it's not impossible. I mean, like 20 years ago, they had different, emerging market hedge fund manager, monthly, 6-month, 5, et cetera. So it's something that would be nice to see, and I'm sure we do great. And if we did, the results, the proof's in the pudding. The overall has done fantastic. But when you say that a quarter of quarter of our funds are shown against a index, which is a small cap, that is completely volatile, has been terrible over the past however long, I think it distorts the overall view we're getting. So anyway, that's why I get in the weeds on it. So that's that. Enough discussion with
The
it.
other question is, how do you boil that analysis down into a single number and put it on this page?
Right.
I don't know if that's possible.
Yeah.
So, but maybe, it's definitely worth discussing. I think they do that. I think you guys do all those things.
Absolutely.
It's just not
Things
here.
at an individual manager level, but
Yes.
you're absolutely right, Dan. It's hard to boil that down. So when you look at that at a kind of rolled up top level number, because you can't, I guess we could go through and, take every manager that we have and do, you'd have to do some kind of combined benchmark by vintage year or something. You end up getting this, you basically get the overall benchmark, right, for private equity or venture cap or whatever it is over 5 or 10 years or 15, whatever. That may or may not reflect, I'd say not typically, exactly what we did. And but it's close, right? I mean, we don't look terrible against that or anything, and we'll show you that next go round, so we can kind of get into that discussion. But I'm not gonna say we shoot the lights out either, but I think there's rational explanations for why we're not trying to shoot the lights out there as well. But
This is Jim. This is Jim, by the way. I've been listening closely to this, and I'll just weigh in with a very short couple of comments. One is that I can't say enough about doing this not as a sort of a general conversation, but with a document and an analysis in front of you that's comprehensive in nature, that looks at all the various approaches to benchmarking private equity, the education session that Becky's talking about and John is talking about. Otherwise, this conversation, I can tell you from history, just goes around and around. The second thing is, I predict with high confidence that any search for the best benchmark for private equity is almost destined for failure from the get-go, because there is no one benchmark that tells you all the things you would like to know. Like, one may tell you a great deal about how well private equity and your allocation is performing relative to the other uses for the capital, but it might tell you nothing about how good your manager selection is. Another might tell you very good, or with high confidence, how good your manager selection is, but it doesn't tell you anything about whether or not it's wise to be in the asset class at all. I predict with high confidence that, as John pointed out, we have a benchmark in the portfolio, and many of our clients use secondary benchmarks to try to capture more of that look, more different looks at the performance of their private equity. And that they also, as a matter of course, whether they're part of the official benchmark or not, they look at other ways to measure the effectiveness or the performance of the private equity program. That's exactly, if I were a trustee, what I'd want to hear. So I'll stop there. That's my 2 cents.
All right, good. So it sounds like we'll get a taste of that in October, along with some additional training. So
You get 2 tastes.
2 tastes, a double dip. So
Sounds great. Look forward to it. Well, I've got just a couple more pages and I can wrap up at those, most of the main themes I want to hit on, we've already hit on today. Page 26 is just a good reminder that still most of our volatility in our portfolio is driven by our equity portfolio. If you look on the bottom right-hand side, which is the contribution to volatility, the actual period-to-period change in return in our portfolios. If you look at the green bars, domestic equity contributes 56% of the volatility, international equity contributes 25% of the volatility. Combined, that's 81% of our volatility is driven by the equity market, compared to we only have 34% of our assets in equities. That's just one of the things that we have to live with equities. And this is looking at the midpoints, as you can see on the left-hand side in the blue. So this is something that's just interesting to note. It's similar with almost every pension plan that we meet with. They have a lot of diversification that's there in the portfolio. At the end of the day, making sure you know how much equity risk you have is very important. And so we measure that in your risk report. Page 27 actually looks at the last 5 years to see, do you have asset classes that are diversifying each other, which is another thing we'll look at in asset allocation. Under domestic equity, which is the left-hand side of page 27, you can see that international equity relates to domestic equity about an 85% correlation. If you look at fixed income, it's actually about 60%. And we'll talk about the reasons for that, but core fixed income and non-core together do have a diversification with equity, but it's a little higher probably than what you would expect looking at the last 5 years. Real assets, about half the time they move like the equity market. Real estate, almost no semblance of return patterns that are similar to the equity market. That's a good thing. And then cash, almost no relationship, and private, very little relationship. So this is just a proof statement that correlation is evident in our portfolio.
Okay, so sorry, so looking at this green, the one above it, the two
Uh-huh.
charts. The contribution to volatility risk is primarily equity because it's mark to market, right? I mean, like, we have no idea what the private investment volatility is.
Because it's not mark to market.
That's right, so
frequently.
is that, tell me what this blue visual, the chart next to it,
The chart to the left is the current midpoints that we have.
what does that mean?
That's within the asset allocation ranges in our policy. Those are the guidelines. And this is the midpoint of the minimum and maximum for each asset class. Is that?
Well, this is Jim again. I'm gonna jump in on this point because I think it's an important one. And that is that, yes, it's true. We don't know what the true mark-to-market, day-to-day, apples to apples with mark-to-market asset classes, what that vol would be for privates. But what we do know is that the plan, John and his staff need to come up with cash on a monthly basis to pay benefits. So those assets that are accessible on that short time period, it's their volatility that has the biggest effect on the fund. And so even though there is a apples to oranges issue in the contribution to volatility, I would argue that the vol measure is quite important when you get to the fact that that benefit payments need to be made and can't be skipped. It might be different if we were talking about a build wealth to a distant date objective, but that's not what a public pension plan's objective function actually is. So I'll stop there.
Like, probably taken up enough of your time. Those are the major topics I wanted to talk about today, but I'm open to any questions anyone has in the balance of the report.
I just got a quick one.
Sure.
After going through all this, is there anything that we should be thinking about doing differently than we are right now?
From a structure perspective and asset allocation perspective, we're going to be talking about that in an upcoming meeting, but still feel very good about where the plan is from an overall structure perspective and all the asset classes you're participating in. So really nothing to do there, but it's, as with every asset class, there are things to continue to monitor in each one of them. And some of the things that are top of mind certainly are that we have an economy that has been balancing between, first quarter, we actually saw a contraction in GDP, then we got this blistering 3% rate. One of the things that we haven't seen for a while is a bad credit cycle. So this is something that we keep in mind in all the fixed income portfolios, as well as in the private credit portfolio. Real estate, continue to monitor it for what's going to be happening going forward. You have a low office allocation in your overall real estate portfolio. That has really been under pressure still. So those are things to keep in mind, is how to continue to diversify in real estate going forward. So those are just examples of, there are themes in every asset class that your team continues to look at and watch. But the thing that I would issue as, let's not be complacent. Let's all be recognizing the risks that we have, in that the US equity market is very fully valued. We can't ignore that we got a nice return for the year out of US equities, even after a lot of bumps. We can't over depend on one strategy. The answer to that is, you aren't just in US equity, you're in non-US equities. And that has been something we've been very happy about. We've gotten used to having higher yields in fixed income, but if the Fed is going to come and start reducing interest rates on the short end, that means there's probably less to be had in the STIP portfolio and in cash portfolios going forward than what we have. So, there's a lot of themes that are current market oriented that we got to keep in mind, but the overall structure is still solid and is continuing to work for you. And we'll come back with more details on that, but again, pretty happy with where things are right now.
Yeah, I couldn't agree more with Becky. You know, we just spent an entire day and then some with your staff looking at each of the asset classes and the sort of micro intra asset class challenges that your staff is facing. It was a great discussion, absolutely great. But from the trustees level, if you ask that question, and as Becky said, there'll be a more detailed discussion of this at the next meeting. I think there's two takeaways. One is I think you should take great pride in the structure and operation of the investment program that has been built at the Bureau, which the board has supported in so many ways. I mean, it wouldn't have happened without the board directing it, financing it, ordering it, making it happen. And the second thing is very similar to Becky's. If I were sort of advising a fellow trustee and asked me that question, I'd say, boy, we need to spend some real time understanding that portion of the RVK report that deals with risk. And it's because of the high historical valuation for US equities. One of the trustees in the conversation, which I listened to the whole time, mentioned compressed spreads in the fixed income market. The fact that you have considerable allocation to illiquids despite an increasing mature pension plan, that risk report, those risk measures should be second nature in terms of understanding their direction for every board member, in our opinion. So I'll stop there.
Thanks, Jim. Anything else for Becky? Thank you.
Thanks for the time. Appreciate it.
All right, moving on to tab 8, investment update. Or do we need a break? Kind of ahead of schedule.
We take our own breaks.
Just taking them as.
Thanks as we go. All right. Let's do the investment update.
All right, thank you, Mr. Chairman. Tab 8. So on slide 4 here. Economic environment. Talked about it quite a bit, so I won't spend a ton of time on all of this, but real quick, I guess I would just say, you know, kind of mixed metrics recently. Recent data probably indicates slowing growth, but not a recession at this point in time. Certainly a surprise here fairly recently. I'm sure you all saw the revisions that we had in the job market. That has probably pushed the market towards expectations that the Fed will actually start cutting rates in September. TBD, we'll see what Chairman Powell has to say here, as Becky pointed out, when he's at Jackson Hole, but that's pretty much the expectation at the moment. Inflation, you know, some indications that probably tariff impacts are trickling through a little bit and hitting inflation, but really in the scheme of things, far less severe than what was feared at this point. I think probably still TBD in terms of, you know, is there more to come or not, but things that we're certainly watching closely. So a little bit up in the air, I think, at the moment. Slide 5, you know, kind of the key metrics to watch, I think, here going forward for the next several months is inflation data, the payroll data, of course. That's going to be a big one, and then wage growth metrics. Wage growth, I just point out at this chart here, which is the dotted blue line, kind of just above the dark line, which is in the inflation, US CPI, ex food and energy, has been outpacing inflation over the last, you know, couple of years here, basically at this point. And the reason that's notable is I think it's kept the consumer in the game, right? So they're still, you know, making higher wages than even if inflation's going up a little bit more quickly than maybe we would have liked or the Fed would have liked. You know, wage growth has more than kept pace, at least in the last couple of years. And so that has maintained a fairly strong consumer, which is why I think we're sort of where we're at the moment. Slide 6. You know, I've been working here for 20 years and I've heard since probably the day I got here about how bad the debt levels were in the US and all of that. You know, it's been sort of a constant fear, if you will, but I think I'm starting to get to the point, maybe the market's getting to the point a little bit more so that, you know, it is concerning, right? At the same time, most other developed countries look as bad or worse as we do. Perhaps Germany is, you know, one of the few exceptions. But if you look at that chart on the upper right-hand side there, and you look at, you know, the federal deficit, particularly, I think, the interest payment portion of it. So that's the blue portion of the bar there. It's growing, right? So we've got a very large deficit. Interest rates have come up. Maybe they'll come down a little bit here, but the cost of just paying the interest on that deficit is getting to be rather burdensome. And so I think it's notable nonetheless. The chart down below, debt as a percentage of GDP, I mean, we're at levels that we last saw during World War II. It was a rather different time, and then we paid that debt down post that rather significant event. We're in arguably one of the best economic periods we've ever had, and we continue to grow that deficit. So, you know, it's just concerning that if we hit the next crisis, whatever that may be, we've got a lot less room to maneuver than we have in the past. I don't know, you know, what the tipping point could be, or if there is a tipping point out there, but logic would suggest there is one somewhere. I don't know what it is. So something to keep an eye on and think about in the long term. Yes. Maybe in the same vein, slide 7, keeping an eye on the value of the dollar, which is, you know, tied to that federal debt level, right? As we have to make those payments for the deficit and those interest payments, we need to print money in effect to do that if we've got a large deficit. So more dollars, and unless we have higher growth than what we expect and thus higher tax revenue, if that does not materialize, then, you know, we're going to print dollars, and a bigger supply of dollars means, you know, kind of supply and demand, that there's a greater supply of dollars, then the value of that individual dollar is going to be somewhat less over a long period of time.
What do you project forward for growth? I mean, like, and I'm sure you have different
Well,
numbers there.
right now, I'd say general consensus is a little below 2% for the next few years. I'd say that's in the US, I should say. I think probably general consensus is that we're in a slightly slower growth environment globally as well. We would need something, if we're running a 7% deficit, we would need something significantly higher than that to sort of, you know, we could continue to run deficits at, like, say, 3% or something, and that probably wouldn't be particularly concerning. So we would need, you know, much higher growth in order to be at a more comfortable level. So along those lines, slide 8, we've touched on it here a few times here and there, but AI is certainly one area where maybe we get that higher growth. And if we get higher growth and productivity because of what it can deliver, you know, that would be great. And businesses are certainly rushing to spend money. CapEx spending has been, you know, astronomical, really. It's kind of amazing. See it here on the left-hand side with the hyperscalers. So kind of the big tech companies are spending on AI, and they expect a payoff to that. And there's a reason that they're doing it. So they're expecting, you know, I've seen I'm kind of quoting estimates here that I've seen from a few different sources of, like, you know, $3 to $10 for every dollar that they spend. But that's, you know, not fully realized yet, I guess I would say. And certainly, I guess, as I sit back and watch it, I can remember the tech bubble, as I'm sure most of you can. And I sort of wonder, like, where and when does that sort of thing happen in AI, where the excitement gets a little bit too much, and do we overspend CapEx in some of these areas? I was talking to one of our managers the other day. We were talking about, you know, just close to Montana, the fiber optics network that we were all going to put fiber optics in the ground, and this was going to be the greatest thing ever. And there's a lot of dead fiber optics out there, and companies that hit the wall because of it. So not saying the same thing will happen here, but also something that we have in the back of our mind as we get approached an awful lot these days on various AI investment ideas. So questions on any of that before I move into the asset classes and such here?
I think it's good to proceed with caution on that.
Yes.
I think that is, yes, that's the word of the day for what we are. We've been looking at a lot of this stuff. So slide 9, assets under management by asset class, no real big changes to call out here, I don't think. We did top 30 billion for a very brief period of time, but STIP's been moving down a little bit as we got some other things in, so still probably in that same ballpark today. Slide 10 by participant type. We talked about it, few of you a little bit before. GoTrust will probably start to show up in this chart, and then just a couple subsequent charts here. We didn't actually get the money until July 2nd, so this is June 30th.
Is it one of the little tiny slivers?
It'll be one of the, yeah, because it's in two, actually in two MUs, so it's in the pension piece and the distribution piece, so it's roughly 250, 275, but yeah, it should probably show up in one of the smaller slices here, or a couple of the smaller slices. Slide 11, assets by pool. No real big changes in trend or anything here other than don't see it this quarter. You'll probably see it a little bit more next quarter. STIP's probably been moving down a little bit more, shrinking as entities have spent down some of the STIP money that they had with us. Slide 12, asset allocation for the pension, well within all of our approved asset class ranges. Similar to the last couple of quarters or so, I would say, and slightly below the midpoint in domestic equities for many of the reasons that we talked about. Valuations there look a little bit rich. Been wrong. Should have kept every dollar in there and then some, but that's okay. Wasn't as prudent at this point to keep a little dry powder there and make sure that we have benefit payments available and things. And we've had some bigger cap calls for some other stuff. We're a little bit above the midpoint in real estate, as we have been for some time. A lot of that's been from our core real estate managers who have not returned capital as we would have hoped, as we've talked about in the past, but you know, we continue to make some progress there and kind of holding steady. And yeah, other than that, little heavier in cash probably. Slide 13, overall asset allocation. Again, you know, not really much to say here in particular, other than most of the growth is, as Becky already talked about, has kind of been domestic equity and international equity. Certainly a wild ride throughout the course of this last quarter anyways. Slide 14, overall net performance. You know, a great 1 year result here. A lot of dollar value add over the course of the year, well in excess of what our benefit payments were. But really, as always, more importantly, would point you towards the longer time frames where, again, we've significantly added to the corpus of the pension over those periods of time, well in excess of what we need to pay benefit payments. So that's, of course, what we would like to see. Slide 15. So we exceeded the actuarial hurdle over almost every time frame on this slide. 20-year, we're just barely below. We're a perpetual pension fund, so the longer time frames, again, certainly the most important for our purposes and what we care about most. Questions about pension? I move on to the other stuff.
Keep it in the nines.
You sound like Dan. So, like Dan. He's always telling
Everybody
me
be happy.
that. Well, I'm sure they will.
What do you do when,
And I will if I can,
yeah, well,
subject to market forces, of course.
so how much, just on those pensions, when you said somewhere a minute ago, what do you do if you have a series, you know, 6 months or 12 months of really poor performance everywhere? What's the
Yeah.
contingency plan for making sure all those pension payments can be made?
So, I mean, we're never in a position where we can't really the pension benefits, right?
You raise it out of,
So,
you just cash out what you have in order to do
I
that?
mean, if we got to that point, so 2% cash, let's say, which is pretty typical what we have. A little bit more right at the moment, but, you know, we could probably make benefit payments for 4 or 5 months just out of cash. Okay. In addition to that, we've got real estate spinning off some payments, fixed incomes spinning off some payments. Most of the time, to Becky's point, why we're diversified. If the markets go down, some asset class is going to have done well, hopefully. Or at least less bad than other things, right? Oftentimes that's treasuries. So a lot of times when you're in the, you know, markets get hit really hard. I'm gonna walk over to John Roscoe's office and say, okay, I need to raise, you know, 50 million for this month, and that's where we're gonna pull it from, but it varies, so. You know, over recent months, not that we've been in that kind of a position, but I'm always kind of looking at it and saying, okay, domestics had a really good run, let's take some from there. Maybe non-core fixed incomes had a really good run, spreads are really tight, okay, let's take some from there. The REITs, Ethan's world, so you just pick and choose the best you can. At the end of the day, you have to pay those benefits. And so you want to do, what you want to do is the least amount of damage in a down market so that you can enjoy the recovery, right? And that's why we're diversified. And I can remember sometimes, not that I was the CIO at that point, but in the financial crisis, you know, I mean, Cliff's running up and down the hall and he's searching hard for something that we can sell. And that was a long time. A couple of years of pretty tough markets there. So you have to be prepared for that, but I think we are. We could, just out of treasuries, we could sustain payments, say, at least a year and a half. We sold nothing but treasuries, and usually treasuries, they might be down, but they're not down nearly as much as the stock. So,
It's just one of those constant day-to-day things. You're always
yeah,
doing whatever you have to do to make sure those pensions get paid.
absolutely. Yeah. Okay, slide 16, assets under management ex cap. Again, nothing unique here. Go Trust stuff will show up here next quarter as well. Slide 17, the STIP pool. Main thing to note here, so STIP reserve was 108 million at quarter end. That is above the 1.15% that we have in policy that we're going to have as a reserve over the total fund. So we turned off, as I think we told you before, we turned off the reserving July 1st. Interest on that reserve will go towards offsetting the STIP costs going forward. And STIP balance has been going down. So as of Monday, STIP balance was about 8.3 billion here, over 9 June. So has come off quite a bit since.
Is that specific to any certain participant, or is that just kind of across the board?
I think it's been relatively across the board. I think it's a lot of, you know, some of the COVID funds are having to be spent in order
COVID
to.
funds are drying
send them
out.
down.
I mean, the interest on the COVID funds are still there. There's a ton of money in the capital projects line. And until we get through that process and start building things, I think there's like 700 million in the backlog. So there's quite a bit there.
A lot of local government spending at the end of the year. At
So
the end of
they
the
would-
fiscal year.
At the end of the fiscal year, they'll draw some down. The biggest draw at the end of the fiscal year is there's 2 OPI payments for K-12. And that's several hundred million that goes out the door instantaneously.
Yeah.
You know, next month when you come back, you'll see the blip like we did last biennium of when they did the rebates.
Yeah.
So we'll see that sort of tick down and come back up. Next January, when the income tax collections go down from the tax cuts, you'll start to see that number come down a little bit more too, so.
The schools use STIP funds though.
Yeah, schools are, a
So the
lot of
money
those,
that comes out of OPI should just go right back into the school till they use them.
it goes A to B, but they make 2 months of payroll payments. So if you're a teacher, typically you get your June, July paycheck in June.
Yeah.
So it comes in and goes right back out.
STIP performance on slide 18, STIP yield is currently 4.03, so it has been coming down a little bit. Expectation, I think, of lower rates there, and if the Fed ends up cutting, obviously it'll probably come down a bit more over time, but still pretty good. Well, that's the one I was running STIP most of the time.
Yeah.
Slide 19, trust funds investment pool. Here again, well within all of our approved asset class ranges. Private credit, we had our first very small call, so at least shows up on the page here. A couple people while we were in Chicago did have Thomas, I think Thomas and Ramasco maybe went to Deer Path, but they will start pulling down that initial commitment that we have with them over the next 18 months or so. We will keep funneling money into some of the plus sectors here as we've got new money, particularly from GoTrust. As we mentioned, GoTrust is kind of regularly going to be buying into trust fund is the thought here. So kind of because it's, you know, close to $600 million, that's not a super small piece in trust fund, and that kind of changes the denominator a little bit of some of our plus sectors, but we've got additional commitments that we're making there to try to keep that going. Yeah.
Yeah, just a question on interest rates. I noticed at the end of the trust fund investment pool discussion, the last bullet point says, based on current market rates, yield increases are expected to continue. So I was wondering if you guys were making an interest rate call there, and I'm wondering if it applies to the yield curve steepening to where the short end comes down and the long end goes up, or if it's just a different allocation within the trust.
So we're not making a call there. It's just that trust fund, you know, has, call it six and a half duration, whatever it is right now. So it's, I mean, it still has a lot of bonds in it that are, you know, 2% yield or whatever. As those things roll off from sort of the historical lower interest rates, there's still runway to keep investing at higher rates. That's really what that
So
is.
part B of that question, though, a lot of people think are hoping that when the low end comes down, the long end comes with it.
Yeah.
I'm kind of in the other camp that thinks the long end might go up, but
Yeah.
where are you guys at?
I think that I would generally kind of agree with you. I don't know if the long end goes up or not, but I think it's gonna be tougher for the long end to come down. All of some of the debt and deficit conversation that we had, I think that will impact that. So, yes. Trust funds performance on slide 20. Basically, there's higher yields. Current portfolio yield to worst end is 4.7. And so I think there's just still runway there, even if the short end comes down, that we'll have still some increasing yield that we can get for participants over time there. Questions on trust funds before I move on? Other questions, I should say. Okay, slide 21, state fund. Similarly, we are within all of our approved asset class ranges here. They are also in Deer Path for private credit. Keep pushing that up. We'll probably we've got one of our other private credit managers that we've had for quite a while is also kind of coming with an open-ended fund, which I think we'll be participating in, which is likely going to go into both trust fund and state fund. So we would like to move that private credit allocation up a little further in the range over time.
Right now, there's only one private,
There's only one right now.
and who's this new one? Who's the new one
The
you?
new one is Tree Line. You know, if you recall them at all. Very similar, senior secured, you know, kind of very high quality.
Relative to state fund, I noticed that their assets went up. They were running in about $1.47 billion. Now that we got up to over $1.5 billion, is there a reason for that? Is it just that?
Great management,
Or by-
great investment management.
They're not spending the money that they need.
They have not spent anything down, although we met with them yesterday and things are going well, I think. They'll obviously be doing their dividend again. So that will, you know, they'll let us know what
Well, they're adding
that ends up being.
And they lower premiums too.
They did lower premiums, I want to say
15%.
5-6%.
Yeah,
something like that.
5%. So
Yes.
Not on everybody.
Except
we
for-
can't speak to experience ratings at the Board of Investment. But ours did go down.
Okay. Thank you.
State fund performance on slide 22. Good performance versus the benchmark here over all timeframes. We talked about before and similar to what we've seen, Mark, to your question, I guess, you know, they kind of see it here kind of in the 1 year. You know, we had a little bit better performance in the year and they have tended to just kind of, the primary draw tends to be the dividend. It's not to say that they can't draw on the investment portfolio if they want to, but they tend not to take too much from there typically.
It's like any other insurance company, they're parting
We've come a long way, buddy. We've come a long way.
Somebody who knows.
All right, and then finally, for me at least, slide 23, you know, I guess I would say market uncertainty still remains relatively elevated as businesses across the board sort of work to navigate all the myriad of policy changes and economic data that we've seen coming in. As noted, we're staying a little bit underweight domestic equity here, a little bit higher cash levels, just to give ourselves a bit of flexibility. No big swings here overall. Had a good meeting with RVK, as Becky talked about, and Jim talked about, Mr. Jim, I should call him. Ask me about that later. Only known as Mr. Jim from now on for me. So we'll be doing the board training in October. You know, we talked about asset allocation, but we also talked about the VC plans, the state fund, AI stuff, lots of different stuff. So it's always good to kind of have that offline conversation with everybody and be able to go in a lot of directions that maybe we don't or can't in a board meeting. We're still working furiously on the DC plans. And meeting with managers, custodians, and power, fixed income team and public markets team, and even Matt and operations has got thrown into this mix. So we're doing all kinds of stuff. More to come there. We've been looking at the AI stuff, as Dan mentioned before. I think we can find some efficiencies here. I would say, you know, broadly, we tend to ask our managers about this too when we have meetings with them. Seems like it's been pretty consistent that people are using it still for just kind of gathering information, at least in the investment space, you know, helping do the research, but that there's still high people touch in terms of all of that still. So I don't feel like I've talked to anybody where I think like we're really behind the curve somehow or another, and seem to be right in line with what others are doing, and maybe unless except for the quants, who were always, you know, running far ahead in terms of what they're doing with that. But most people are not that vain.
If you asked AI what to invest in, probably say AI.
Yes.
If you don't, I'll power off your computer.
Good summer with the interns. They did a lot of good projects for us here, I think. Listed just a handful here. I handed out the nice thank you note that we got from Olivia, so, it's great. I think it's all working as we would hope, and I'm sure we will continue that in the future, and I will try to go to Tim's class and other people's class and, you know, keep getting interest from the students to come and do it, because I think it's worthwhile, and hopefully. And then, finally, Willie has transferred out of fixed income. Apparently there were some problems with Ramasco, you know. We don't want to get into that, but he was eager to leave is what I heard, and he's very happy now as the new private investment analyst. We don't intend to replace his position, at least at this point in time. I don't think we need to. As you know, we brought Ethan on not too terribly long ago, so we've just thrown him into the fire a little quicker maybe than what he otherwise would have been, but of course, we're still in good shape there. And speaking of Ethan, he passed level 2 of the CFA just recently. Absolutely no surprise. As you watched him deliver the fixed income basics, I think you felt confident that he at least aced the fixed income basics portion of the test. Apparently all of it. So that's it for me. Happy to answer any other questions, but if not, I'll turn it over to Aaron.
Good evening, Mr. Chair, members of the board. We'll be on macro attribution, page 24. I'll just focus on the key takeaways as always, but feel free to ask any questions as we go. Strategic asset allocation, all benchmarks except in real estate provided positive contributions to the pension policy neutral 10.75% return. Moving on, tactical asset allocation. Sales of equity, fixed income, and cash all contributed to funding the pension net cash need of $522 million for the year.
Hey, I'm sorry. So the 10.75, so this is just the pen. So I'm just trying to tie this back into what we saw today. So where's the
The
This is a 3-year.
% return is what we would have earned if we'd invested in our asset class benchmarks at the midpoint weights.
over the past 3 years?
Yes.
Okay, got it. Thank you.
In aggregate, the overweighting, underweighting of the asset classes relative to their midpoints decreased the pension portfolio's return by 38 basis points, with the underweight to domestic equity providing most of the underperformance. So this is a little larger number than we've seen here in the last few quarters. That's really a function of the really strong equity markets this last quarter. Our domestic equity midpoint is 28%, and we've been sitting at a little bit around 26.4 on average this past quarter. Of course, that's kind of where we're selling generally to pay the benefits at month end. Style selection, all my comments are again kind of generally the same. So I'll skip down to manager selection unless there's any questions.
No, talk to us about manager selection here.
Well, I'll point out the big one here. Private investments manager selection affects negative 159 basis points for this 3-year period. So when I showed this to you last quarter, it was about just negative 7 basis points. So what happened? So this is very time period specific. This is a 3-year analysis. In Q2 2022, private equity outperformed its benchmark by 22%. In Q2 2025, private equity underperformed its benchmark by 8%. So we lost the benefit of that good quarter and we gained this poor relative performance quarter. So it kind of illustrates the time period effects of our analysis. And this, which is why we typically point to longer time periods, especially when it comes to private equity benchmarks.
I think this goes back to the discussion that you were having, John. We need to look at private equity or private investments and how that's seen.
So is this second quarter, this reflects the small cap indice being so underperforming?
Yep, it does. We gained Q2 2025 where private equity underperformed its public equity benchmark, the small cap benchmark. And what we're losing here, so Q2 2022 is no longer a part of this 3-year analysis, right? And that's when our private fund outperformed by a lot now. Of course, that's largely somewhat due to the marking to market of the investment portfolio. So does that kind of help illustrate? It's really why we point to the longer term time periods because in these short-term timeframes, you can have these kind of swings with the private investments.
It's descriptive of the issue.
Yeah.
It's the nail on the head of the issue that John's raising.
Correct. That's all I have for macro education. If there's no further questions, I'll pass on to Jason.
Thanks, Aaron.
Chairman, the board, it's me again. Maybe I'm understanding myself, it's my encore performance.
You think non-core is cool, you think your domestic equity.
Domestic equity is coolest. Which you will see on page 27. A lot of this we've talked about before, so I'm going to skip over things, but a few highlights. We talked about how value stocks had outperformed from the beginning of the year, going through the downturn that we had in early April. That has reversed sharply. So the Russell 1000 growth is up about 40% off its April low. Russell 1000 value is about half that since early April. And we've talked about small caps, how small caps have lagged this year. Recently, there's been a bit more optimism as the market's more hopeful about prospects for interest rate cuts this year. Move to page 28, you see our sector weights very close to those of the benchmark. Since we are indexed, the slight differences come from the overweight to small caps, which you see in the bottom right-hand corner. That has been pretty consistent overweight, generally between 5 and 6%. Page 29, you see valuations with the market rally, PE multiples are up again. The S&P 500 trading at 22 times at the end of the second quarter. And with a strong large cap growth rally, the concentration in the US stock market has also increased. But it dipped a little bit in the first quarter, and recently, the last couple of years have been in the low to mid 30% range. It's now up to about 38% of the top 10 stocks in the S&P 500. Any questions about Mr. Pedals? International?
Yeah, sorry, this is one question. So on that graph, the S&P index price to earnings ratio, it's a little less than I would have thought. I mean, like, with the valuation compared to 2020, which I'm sure was an extraordinary year. I mean, what's your feeling there, I guess? Obviously, high valuation, nervous. I mean, what is your, kind of what's your thought process on that chart that you have there when you look at it?
Yeah, boil it down to a couple things. First, this is the way the market talks in terms of PEs. If you look at the PE today and compare it to history, the S&P 500 is drastically different than it was, its composition, than it was 5-7 years ago.
Oh, sure.
The amount of tech in the index has risen dramatically. So that makes the comparisons a little trickier. But two, and this is less of a quantitative metric, is how do we feel about the sentiment in the market? And I think John would agree, and I would agree that expectations are relatively high. And so that is a little concerning. The higher the expectations are, the more at risk you are for that changing and having a large sell-off. And so we've made a couple minor bets. One is we've been underweight our midpoint in domestic equities for the last couple of years. And two, that overweight to small cap, which is partly structural, but two, based on valuations. The discount of small caps to the large caps is about as high as it's ever been. International equities on page 30, even with the recent strong US stock rally, international equities are still ahead of the US year to date and over the last year. Value stocks have outperformed growth international this year, which is contrary to what we've seen recently in the US. Large caps and small caps, international, pretty close in returns this year and over the last year, not a huge difference there. But the big story we talked before is the weakness of the US dollar. The boost to the ACWX US index year to date has been about 8% from currency effect. But really the big tailwind has come in Europe. Eurozone stocks have seen a boost of about 15% to the returns year to date from the weaker dollar. And if you look at emerging markets and developed markets, so EM has outperformed developed in local currency terms, but the currency effect has pushed the developed market returns ahead of EM year to date. Page 31, the upper left-hand corner shows our position in EM versus the index. As I mentioned before, this is due to the aggregate exposures of our managers. It's not something that we actively manage ourselves. A slight overweight. Same story for small caps in the bottom left-hand corner. Our managers combined have a slight overweight to small caps.
And that's the manager decision. It's not,
Sorry,
that's the manager, the small cap deal, that's the manager's decision, not our decision.
yeah, it's a little bit different than, I mean, domestic, we looked, since we're indexed, we kind of manage that more actively. On the international side, less so.
But we're, in both cases, we're overweight in small caps.
And bottom right hand, a little less in active management than we did in the first quarter. We did a little resizing of a manager in the second quarter, but generally speaking, over the last couple of years, active has increased. Page 32. As in the US, stock rally has seen higher PE multiples overseas as well. And in the past, I've spoken about the discount of international stocks to US. That had shrunken a little bit in the first quarter, but that grew again. And at the end of June, that discount was 36%. Any questions on international? Into non-core fixed income. Again, we talked about a lot about this earlier. High yield had bounced back from the volatility in early April, posted strong returns in the second quarter. I mentioned how convertibles and emerging market debt had been the top performers this year and over the last 12 months, each posting returns in excess of 12%, which is excellent. In 2024, the theme in high yield was for lower quality bonds to outperform higher quality. And they did by a wide margin last year, but that has shifted a little bit this year. Not in a huge way, but triple C's are trailing double B's and single B's so far this year. Turning to page 34. We talked about the sector exposures and the credit rating exposures. You see in the bottom right hand, the breakdown by strategies, the total. Over the last year, we made a few changes, minor changes, but we have trimmed some high yield and added its contributions to emerging market debt and to our convertible strategy. Page 35. So with the volatility, we saw spreads widen by about 200 basis points from mid-February to mid-April. They've since tightened back to under 300 basis points. Not quite as tight as before the sell-off in April, but still on the tight side relative to history. And with that spread compression, yields have dropped in high 8% range and to around 7% at the end of the second quarter, which really is about an average level that we've seen since the post GFC period. Any questions?
What was the cause of the 2020 jump? I forgot.
With that?
What was the cause of the 20? I mean, you just look and it's so dramatic that 2008 is unbelievable when you look at this spread. What was the jump in 2020? I forgot what that was.
COVID.
That was COVID. Oh, COVID, of course.
It's so easy to forget. Oh, yeah, I'll definitely forget.
Yeah, seriously. Wow.
We'll never forget what.
Which, you know, if you look at the chart, just to add some commentary, and you see the little blip here. In 2025. The sell-offs and the spread widening can be dramatic. It doesn't always last very long, right? And you see in 2020, some of that was the sell-off. Fed made some statements, kind of said they were going to intervene if they needed to, and the market immediately rallied. And defaults had risen in 2020. You can see that in the deep dive a little bit. But I think in 2020, the default rate is a little over 6%. Half of that was energy. Half of that was energy issue. There wasn't a broad sell-off in the high yield market or defaults, at least. Pretty concentrated. Thank you.
Mr. Jason.
Mr. Chairman, members of the board, I'm on page 36. I'll be covering off real estate. And we'll walk you through accordingly. So upper left is our classic assets under management by plan. On the right, we have our dollar value add. And underneath, we have our performance table by plan, the 1, 5, 10-year basis relative to the benchmark. Got some commentary here. I won't go through those with you. I guess I would just leave you with some general thoughts. You know, we have a real estate market that is trying desperately to heal. Transaction volumes are increasing slowly but surely. Price discovery continues. The bid-ask spread is slowly narrowing. Banks are lending, as are insurance companies. The CMBS market is outperforming on a volume basis relative to the last couple of years anyway. So debt's available. I would say a couple things that, at least from my perspective, bode well for us. One is our focus on vertically integrated operators, because I think going forward, we're going to see a lot less cap rate compression, which means values go up, and it's really going to be driven by, and that's largely hampered by, you know, the higher interest rate environment. So it's really going to demand hands-on operations at the property level through just good old-fashioned net operating income growth. And then secondly, supply has been muted across virtually all property types. So in years to come, the demand that is chasing that more limited supply should portend good things for rent growth and occupancy growth. So that's what I would say. We continue to muddle through. I think we're well positioned. It's a very diversified portfolio, North American centric, US centric. Happy to answer any specific questions.
Any specific comments with regard to office?
I guess there's good news there. Generally speaking, I mean, net absorption in New York of late has been off the charts. Same with San Francisco, which were a couple of the markets that were hit the hardest. So I just saw some stats yesterday. Broadly speaking, I think we're still at like 21% out of the office. Surprisingly, I thought anyway, Denver was the top market for people who are reticent to return to the office. Beaten by New York and San Francisco, of all places. So
on that?
I haven't heard any major announcements by corporate CEOs of late, but it's coming back. It's coming back. You know, you hear anecdotally of people buying office for sure. A lot of people are just playing the long game. A lot of it's generational money, family offices. There are institutional funds that are chasing office. We are not. We are de-emphasizing office. In fact, we have been actively de-emphasizing office even pre-pandemic, and that just stems from my philosophical bias that office is it's one of the highest CapEx demanding property types. It's one of the lowest net operating income margin property types out there. It's highly correlated to the economic cycle, and there's other much cooler, much more recession resilient property types to be in that offer better lease terms, higher probabilities of renewal, higher general occupancy, et cetera. And we could get into that and I could continue on, but I won't. Other questions? Seeing none, we'll flip to the next page, where we'll touch on the diversification on the upper right. Upper left is our asset allocation within the real estate asset class, all well within our stated policy constraints. And then you'll see the cash flow and net asset value behavior through time. Again, I'll just reorient you. This is just our private investments and is not reflective of our public REITs or our publicly traded high yield CMBS mandate. Questions? Moving on to page 38, then we have presented Green Street's commercial.
I'm sorry, I do have a question.
Yeah, please.
So when I look at this capital calls first distribution, what is that a good indicator? I mean, it looks pretty I guess it's been pretty static, you know, over the whole time. So I mean, I guess there's nothing, no indicator there that you could say, hey, if you get more capital calls coming in, that means there's more money going out, more activeness in the market overall. You know, it's not an indicator.
Well, I think you said it best. It's stasis. It's pretty consistent, you know, and honestly, at least from our perspective, it's an indication that we continue to commit capital and sort of stick to our strategic asset allocation irrespective of the short-term noise that's in the market. This is a very long-term illiquid asset class. And it doesn't, at least from my perspective, behoove an institutionally positioned limited partner investor to try to behave tactically within an asset class that is characterized by the two main points that I just brought to bear.
Yeah.
Okay.
Thank you.
So Green Street's commercial property price index as of June 5th. Again, going back to one of the bullet points on one of the prior pages, you can see some price recovery, some general price stabilization. Again, this is a market that is slowly trying to heal, and there are green shoots piercing the soil. Any questions? Seeing none, we'll take you to page 39 where we have commitments made year to date, of which we have 2 new ones to report on. I'm going to turn over to my partner, Rob, to cover off the Blue Owl Real Estate Capital Fund 7, and then I will follow up with Sterling United Properties Fund 1. Take it away, Rob.
Thank you. Great. Chairman, members of the board, good to see everybody today. My name is Rob Sampson, and I'll be taking you through Blue Owl Real Estate Fund 7. So on June 27th, staff committed $100 million to this fund, 50 of which was from CAP and 50 of which was from Trust Fund. This is a group and a strategy that we have a high level of conviction in and have had from some time, as you can see on the handout here. They have a great culture, fantastic reputation throughout the market, and consistently make monthly distributions that surpass our actual rate. That said, I won't dive too deep into the strategy given what's on the handout today, but happy to answer any questions.
I noticed there's a name change here.
Yeah, so wonderful question. Oak Street was acquired. I know. Oak Street was acquired by Blue Owl Capital in December of 21. And what you're seeing there is the final touches of the rebranding efforts.
Okay, but it was an acquisition, so does that change management strategy or, I mean, did you check in for that?
Absolutely. We looked into that for not only this vehicle, but for the previous investment or the previous commitment as well in Fund 6 in 2023. Highlighted it, went through it very, very thoroughly in both underwriting processes. In this case, it does not impact their investment process. And we actually think that it benefits them a great deal from the back office standpoint, because Oak Street, when they were on their own, it was a lot of individuals doing a lot of different things, stretched pretty thin. They're doing it very, very well.
But when you add the resources of a larger public firm, can dig a little bit deeper into what their core competencies are.
I have a question. So we've invested 5 times that amount. When is enough enough? Not that I think it should be because, I'm serious, because of the rate of return looks good. But I'm just curious, when do you decide that, geez, we've got enough there? Maybe it's time to look at something else.
There's no good answer. So broadly speaking, I believe in a more concentrated portfolio, particularly in the private markets. It's about active management and paying somebody for their expertise and harnessing information asymmetries and outperforming and seeking alpha versus spreading risk and building an index and settling for index-like benchmark returns. That's not why I believe we're in the private markets. This fund in particular focuses on a lot of areas within the real estate market, necessity retail, industrial, data centers that we are leaning into and have high conviction around. And this is a great way for us to get very broadly diversified exposure in a big fund in areas that we like, which will complement our growing concentration within the portfolio vis-a-vis our recent separate accounts, which by their very nature will give us more concentrated exposure, but within a more broadly diversified portfolio vis-a-vis funds like this. That will have in order of 200, 300, 400 properties, for example.
One thing maybe I would add on.
Did that help?
Yeah, it does.
Sorry, maybe to actually answer your question, yeah, that's one of the reasons why we've continued to stay with them now. Will there come a time maybe through size or management or something that forces us to look at a different way? For sure, that could come. It hasn't come yet. To Mark's point, we spent a lot of time on this acquisition. And frankly, when they called me in the middle of the lockdown and said, hey, we're selling ourselves, I thought, we're done with you. This is a publicly traded company. But we dove very deeply into sort of separation of duties. Will this be a going concern? And we continue to have comfort today.
So, but you guys do your reviews, your evaluations of all of these investments, and that would probably help you make a decision in the future if things start looking kind of
For sure.
Absolutely.
hinky.
Without a doubt.
They're huge, huh? I mean, 265 billion, that's amazing. I saw 11 for total staff of 1101. I was like, that's gotta be, and then I saw the.
Yeah, they're big, GP stakes, credit, they're a big asset manager, Blue Owl, yep, for sure.
One thing I'd add to your question, Maggie, is just that I don't have it numbers off the top of my head, but like the 2017 Fund 4, those dollars are coming back to us. So that one, I know it says partially realized here. I'm guessing, I don't know if you guys know.
Nearly liquidated.
Nearly done,
Yeah.
probably. So, we're always committing. And I guess maybe one additional way to answer what Ethan said, I completely agree with him. At some level or another, I'm gonna look at that and say, and this hasn't happened, but hey, these guys are like 2% of cap or something or whatever. And at some level or another, it's like, no, we just don't need more exposure to somebody like that. But generally speaking, the nature of these funds, it's like, well, yeah, we invested and it just keeps rolling. So.
If it's not rolling, that's something that we would
Yeah.
consider.
For sure.
Absolutely.
That's Thomas's world next.
We have not re-upped the realizations, for sure. It's happened in the past.
Thank
Any
you.
further questions on Blue Owl Fund 7? Thanks, everybody.
Okay, Sterling United Properties Fund 1, we committed a total of 115 million, 50 from CAP, 50 from trust, 15 from state fund. This was a unique opportunity to participate in a portfolio recapitalization, which we anchored or led. As such, we received some favorable economics, which some of which are outlined on the board brief. We have an existing commitment with them in Sterling United Properties 2. Sterling United Properties One is a 13 property, cash flowing, fully stabilized infill grocery anchored portfolio that is spread across 11 different arguably primary markets across the United States, anchored by grocers that are number 1 or 2 in the market. Vertically integrated, high conviction manager in a needs-based, value-oriented retail space that most of the institutional community left hanging in the wind back during the retail apocalypse, but we leaned into because we had a view that people are going to continue to go to grocery stores. And call it 12 months ago, the rest of the institutional LP community kind of got on board with that and started to bifurcate the retail landscape and finally saw the writing on the wall, which is retail grocery stores are a good investment. And so we leaned into this and partnered with a high conviction current manager to participate in a portfolio recapitalization event and feel pretty good about that. Happy to answer any specific questions.
Describe a portfolio recapitalization event. I mean, so these guys had a portfolio of grocery properties, asset potentials. And then we've helped fund, then they started to fund to take advantage of that. That's the recapitalization. Is that what you're saying?
Yeah, they didn't want to sell. They were at the end of a fund life. And many of their LPs didn't want to sell either, but some of their LPs did want to sell. And so their existing LPs rolled into this new fund. We bought out existing LPs at a current mark as of 12/31/24 appraisals.
Nice.
Spent a lot of time around valuation, got really comfortable there. I think we ended up buying in at a 6.4 cap rate. So current cash flow right off the bat, really good debt on the portfolio. I think the average yield was south of 4% and in place for quite some time. So a lot of really attractive characteristics, which we could get into more deeply, perhaps offline, so as not to share too much.
Very cool.
In public forum.
Thank you.
The IRRs on the previous ones that were in, or twos, running less than 8%. This, did you look at the previous IRR on this before the recapitalization?
Yeah, absolutely. Yeah.
Was it
So
running the same or about that? Or?
yeah. So bear in mind, these are core plus stabilized assets. So they're highly occupied, long-term rents. We're not looking for opportunistic or value add like returns vis-a-vis high leverage, taking up lease up risk, development, et cetera. We're buying, it's essentially a core fund to think about it. So by the very nature of the risk profile, it's going to be a lower returning strategy, if that makes sense. And so very comfortable with those returns, especially when I look at it relative to our actuarial rate of return hurdle, which is frankly the only benchmark that I focus on, because if I can place our capital at a rate of return, not guaranteed, but with somebody who serially outperforms that, I know it's accretive to the portfolio and I know it's accretive to paying benefits long-term. And so I'm not looking for outsized risk. I'm looking for steady eddy, stable, safe returns in property types that are going to be utilized and visited year in, year out, regardless of the economic environment. If that makes sense. Yes.
Hey, did you I love that it's a 15% carried versus a 20, so that's great. I mean, did you guys negotiate that?
That was actually presented, the management fee is what we nailed. And if you look at J Curve's management fee is what really gets you. And so I can tell you what the market was on that. And it was a lot more than what we ultimately got. Happy to discuss that with you offline.
Thank you.
You bet.
So you talked about the funding rates or the debt rates that these properties had being very low. Obviously, so they're kind of longer term. Yeah, they're locked in longer term, so there's not any potential
Yeah, the
Compression down the
refinancing
road.
risk isn't, I'd have to get back to you on the actual duration, but we're pretty locked in for the next, I think, 5 or 6 years.
Okay.
There's no near-term refinancing risk, if that's the heart of your question. And just to let you know even further, if there was, I know that the market for these types of assets would provide positive leverage to the current value of the portfolio, the current cap rate. It's 5.5, 5.25, so it'd still be very accretive debt. Any more questions? Okay, seeing none, we'll go to page 40. And launch real assets here, very similar to real estate, AUM upper left by plan, dollar value add on the right. Performance table and a number of industry data points. Happy to discuss any of these with you specifically, won't take you through them. Or other just broader market observations or inquiries anyone would like to shoot my way.
I guess back to the debt rate. I mean, is that part of the reason why they didn't want to exit these properties is because they have that advantageous financing?
So I would say part of the answer to that question is yes. It's hard to go out and create this type of scaled portfolio. They would have to sell and that would have been good for them, but then there's a whole lot of reinvestment risk that they take to try and recreate that. The other thing that a lot of folks don't know about grocery anchored retail is the grocery anchored retail is anchored by the retailer, the grocer. And that is typically a loss leader in the rent roll. So they get offered a very attractive lease term to come in and anchor the property. The developer brings them in. Hey, Whole Foods is here. Hey, everybody else come in because Whole Foods is here, and that's going to drive traffic to not only, well, to your store, you know, if you're a dog groomer or nail salon or what have you, where you're doing, you know, tax rebates or what have you. These folks typically sign long leases, 20 years, with, you know, multiple extensions at fair market value or whatever, 3% of whatever it was, but these are in the process of rolling off. And so while a shoulder or inline tenant may be paying 20, 30, 40 bucks a month rent, the grocer is paying $2 or $3. And as soon as we get through some of those renewals, we're going to get to charge the grocers 30, 40, 50 bucks a foot on their 200, 300, 400,000 square foot space. NOI is going to shoot straight up through the moon, and our income distributions are going to follow accordingly, as will the value of the overall property. So trading that future income growth away for someone who has a long-term view seems a fool's errand if you can see near term or relatively near term that you're going to be able to get at that rent roll and really jack rents, pardon me. Was that helpful?
Yeah, definitely.
Thank you. Seeing no questions on page 40, we're going to roll right into page 41, where we have our asset allocation per the IPS within policy constraints, our international domestic diversification, and our cash flow and net asset value behavior for our private investments within real assets. MLPs and our tips are not in those flows, those graphs. Any questions here? Seeing none, we'll bounce over to 42, where we have our price action of oil through time at the top and demand and price action of aggregates. I've shown these to you for a number of quarters. I'm happy to take any suggestions if you'd like me to show you anything else. I mean, to Becky's point, oil has been volatile. The trend has been generally down. Lots of uncertainty. OPEC just rolled off its price or production cuts and is hiking. So there's a lot of concern around supply, particularly in a muted economic environment. You know, continued rhetoric in the Middle East, aggregates, while demand was down last quarter, it was, pricing outperformed and continues to outpace inflation by orders of magnitude. So that's part of the reason why we leaned in and did a secondary transaction earlier this year and added our exposure. So like that space a lot. Any questions here? Moving along to new commitments, we have none. Happy to answer any other questions. Otherwise, I'll bid you adieu and thank you for your time. All right, appreciate it. Thank you. Take care, everyone. Thomas.
Thank you again. Good afternoon, Mr. Chairman, members of the board. Thomas Winkler, Director of Private Investments. Just a handful of slides you've seen before. I'll start on slide 44. Similar setup to Ethan's portfolios, of course. The breakdown in the top left. This is the last time I promised that this is going to be a boring chart. We have some more allocations, as you heard from John earlier, private credit, in-state and trust fund. Just this month, actually, we had the first capital calls for both of those. Just under $1 million for state and just shy of $2 million for trust fund. So the chart should look a little bit more exciting next go around. Performance table at the bottom. Dive into that maybe in October a little bit deeper, but performance is within expectations. Major concerns here. Long-term outperforming the public benchmark. And yeah, portfolio is doing as it's supposed to at this point. Do you see any particular questions on that slide? I'll move on to 45. Again, the portfolio broken down by strategy. Geographically, no big surprises here. As I said last time, no changes, no major changes quarter to quarter. Over long periods of time, you might see some fluctuations, well within policy ranges. Again, we're kind of hovering around a 75% equity allocation within the portfolio and about private credit. That was intentional. Less biased portfolio as it always has been and will continue to be. Any questions on that particular slide? I don't see anything. I'll move on to 46. Just a quick overview of macro environment, markets, valuations. You've heard Becky speak about it. Certainly, we've seen a slowdown in market activity, deal activity. Primarily in April, May, around the whole tariff uncertainty. A lot of folks hit the brakes. Not a lot of deals got done. That picked back up in June. We're actually ahead of the halfway mark from last year in terms of deal activity and dollars deployed. We expect it to be rather muted for the remainder of the year because there's just tariff uncertainty, interest rates. Nobody knows what's going to happen there. So it'll probably not be a record year in terms of money deployed and deals being done this year, but activity is still there, at least on our end of the market.
Are you guys investing in the secondaries on the venture side or no?
We are not. And just a note on the right-hand chart, and you've seen that well before as well. The one note I always like to point out is that our GPs, our managers, intentionally are much more conservative when it comes to leverage. So you see the headline numbers 5 times, 6 times levered on buyout deals. We're at least 1 to 2 turns below that. And again, that is intentional. Nobody knows what interest rates are doing. Just don't want to be on the top end of leverage when things move one way or the other. No big questions on this particular slide. I'll move on to the new commitments. Page 47, slide 47. We see nine deals here for the fiscal year. And again, this is as of June 30. So wrapping up the fiscal year with 9 commitments, roughly $500 million committed. The most recent one was Solix Fund 4, which you have a fourth brief in front of you. I'll give you a quick rundown on that particular strategy. That was a new commitment for us, part of our initiative to broaden the exposure in Europe or outside of the US a little bit. Solix is a Danish headquartered Scandinavian focused fund, primarily focused on business services, industrial, think high precision drills, machines, liquid gas pumps, that kind of stuff. So not your hair dryers or lawnmowers. It's certainly a business. What we really liked about the firm was, for one, the track record that they've established. It's an independently owned firm. We always like that, to have the alignment. People actually saying cooking. You see on the page a very high GP commitment, certainly above market. That is all coming in CAF from the partners who we've verified it a couple of times. And then the other highlight was beyond the headline fees and then stuff that you see on this particular page here. And very attractive overall legal terms, very LP friendly terms. Battle to that a little bit offline if people are interested. I'll leave it at that. Are there any questions?
Thank you.
Thank you. Pass it on to Mr. Romasco.
Thank you, Mr. Chairman, members of the board. I can reference slide 48. Things to note, generally strong returns there. The returns came from about an average yield of about 4.7% throughout the year. Plus the kicker from declining interest rates was the big mover of that performance. Smaller tailwind came from a small decline in risk premium. So all those together got us above the yield. Interesting note would be looking at the 5-year return being negative. And so if we look back 5 years, we were seeing yields for the average treasury of about 50 basis points at that time. So the increase in interest rates from that was a headwind for the performance. But does go to Daniel's question about why would the treasurer, the trust fund yield keeping going up? Well, it's because some of these very low bonds will be maturing and falling off. Happy to take any questions there. Seeing none, then going on to characteristics of core fixed income on slide 50. You can see we're a little bit long the index in terms of duration. And so all other things being equal, that would suggest a belief that we think interest rates are going up. I would suggest it's more a play on the steepness of the yield curve and where we're just trying to get a little bit more yield by going out the maturity curve there. Duration metrics for trust fund on 51, about the same as core. And then looking at state fund, duration is a little bit less, but continue to work that out. Yes, brief, but happy to take any questions.
Here, I got one for you. When we look at the duration, I was surprised that you said that 6.48 is a little long for you. Because I'm totally a neophyte on the trading of the core fixed, especially like a portfolio like you guys have. Where would you regularly see it, more towards 5 or something, or what?
So the duration, I'm trying to, I'm sorry, I'm hemming and hawing a little bit, John, about the question.
Okay, I thought that you said when you said that you thought the duration was kind of longer than you would normally, then my thought was, well, what would be normal?
Well, it would depend if we were making an active bet on interest rates, we could see a more significant difference from the benchmark. And so,
okay.
So if you look at us,
yeah,
we're 108% of the benchmark, which is not a large bet, but more of a bet on, well, the curve is upwardly sloping and we're getting a little more yield for going out, but it's not a bet on what we think the long end of the curve is going to do in terms of interest rates. That's a much less certain area there.
So from a portfolio perspective, John, can be plus or minus 20% of the index So the longest he could be would be, 120% or whatever the ag is. Or short, which we've never really done. I mean, probably wouldn't go quite to that max, but
And, underlying that is just a general belief that yield wins in the long run.
Yeah.
So. Thank you.
Ms. Jones? All right. Dan, recap?
Okay, next meeting, deep dive on private investments. First reading of the asset allocation, I'll also notice it as a vote. So that if you decide that you want to adopt it at that point in time, you can.
It's on October 14th.
October 15th,
Okay,
unless we want to go to the 14th.
this one says 14th.
Which year is that?
This is
2025,
2025.
yeah, the.
Hold on. With the, yeah, the 14th says that, and then the other, the work plan says the 15th. Did we move for somebody to 14th? I think we did. Oh, we did. But that person won't be here anyway. So the 14th,
Okay.
yes, the 14th.
14th or the 15th?
It's the 14th.
It's the 14th. Yes, we moved it to the 14th.
Is that a full day, Dan, or?
That's a full day. Yep. We have made it a full day over the course of today. Private investments deep dive,
The face to face,
asset,
Yeah.
yes,
next year is when it goes to.
next year we'll see, yes. Asset allocation, I'll notice it for a vote if you so choose, but if not, it's just first reading. You can delay it an additional meeting and vote on it in December. Securities lending review, one of the places we got a really good review from the legislative auditor, staff performance review, and the SOC audit results. So we will have both HR and audit committee meetings. I know, right? We'll have the pay study that was requested last meeting complete to be presented to the HR committee, cash to cash, peer size, surrounding states, and cost of living. I'm also going to bring to the board a program review. I think there are some programs that exist today that may have outlived their usefulness. One of them we heard about earlier today, relative to the master loan program, and I think we should take a look at just where are these at and should we continue them? Or were they valuable at a time in the past and now that risk portfolio or expertise or other options, to full preview?
This program review, is it going to take legislation?
No.
Okay.
For instance, the IRP program. The Department of Commerce has created an IRP program. Ours is a 2% interest rate that has to be paid back. Theirs is a grant program that you keep for free and never pay back. Well, why would we have duplicative programs, especially when that one's more generous for the EcoDevo side? So I'm gonna bring that to you, 3 of them that I can think of now. We'll see if any more come up and if you have any other suggestions. IRP, the master loan program, and this hell of buildings and a policy revision to walk through on that in October. Anything else I'm missing or that you'd like to see? Okay, everybody does owe me dates for the calendar for 2026, 2027. If we want to rearrange those, I'll adjust those and have them in the tab 2 for your adoption. So you know where you're at the next 27 months.
They're on my wife's calendar, so.
You know, December 10th of next year. Maybe the. Parallel, and then the board meeting's on the 11th.
Okay, well, I'll circle the prior date. Okay.
Anything else?
Not for me, from you?
Nope. Meeting adjourned.
Thank you.